All right. Hello, everybody. Welcome back to the channel. We are here today to start off big tech earnings for Q2 with Tesla and Google. Here with Tanner and Jose. Guys, how you feeling?
Brother, I am so excited to be back with you guys for earnings. I love the NVIDIA boys. I know that doesn't make sense to most people, but that's the name of the group chat. This is some of the best times of the whole year is getting to listen to all these calls with you guys. So super excited. I don't know if you guys just saw it, Amit, I'm sure you'll talk about it, but the recent updates from JP Morgan and UBS for CapEx for Google.
I did
Jose,
indeed see it.
Your jaw is going to drop. I'm not kidding. Whatever you're guessing, double it.
Jose, have you seen it?
I have not seen it.
Okay, well, let me read it out. Let's get right into it. So this was reported by UBS. The big discussion today is CapEx, right? That's the big thing that everyone is concerned about. UBS and JP Morgan, 20 minutes ago. We think Google will report CapEx of 325 to 375 billion.
Dude, it's double.
Wait, for what time frame? Like for 1 year? That's crazy.
The buy side expected 250, but JP Morgan says post the equity raise, the $85 billion that they just raised in equity dilution, investor expectations have jumped to 325 to 350 billion for 2027 CapEx. Or are they, Tanner, do you think they're saying this for end of 26? Because right now end of 26 is 190, but I think they're talking about next year, not this year.
Dude, I thought it was next year. But still, that's crazy. That's essentially calling for a continuous, like what Meta did with the rumors of 7 gigawatts this year, 14 gigawatts next year, that the CapEx cycle is not stopping, that people want to spend twice as much. Not spend as much as we did this year, but spend twice as much. We're not even anywhere near maintenance mode just yet. We're still in the acceleration period.
Real quick, I was gonna say that's also why the stock went from 347 to 344. As soon as that news came out, obviously the stock took a hit on that, which begs the question: if they actually put up those numbers, do we think the stock reacts positively or not?
I mean, but they're doing this for a reason, right? I mean, they're seeing this crazy demand. And if you're jumping that big, right, from like what 185, 190 this year to potentially 350 plus next year, that's not like a small jump. That's that they need to be very, very confident that there is the demand that is going to be needed. Because even just like a $20 billion jump would be insane. But if we get kind of that even extra $100+ billion, there has to be some confidence from management, because you don't play around with that kind of money.
Look, I agree. Obviously, the story this entire year has been that the hyperscalers spend more on CapEx, even though they're growing more because of that CapEx spend. Google's entire business, search, cloud, everything is growing, but the CapEx beneficiaries get the reward of their stock prices going higher, and the CapEx spenders get hit. So, I mean, Google was actually having an okay day. I mean, the SaaS names have been decimated today. Hyperscalers in general haven't been the best, but Google was holding on until that buy-side report came out by UBS estimating about 350 billion in CapEx. Now, maybe that's wrong. We're going to see what ends up happening in the next 20 minutes. But if it's right, I really wonder what happens to Google. I also wonder why NVIDIA is not pumping, because NVIDIA is having its best day in a few weeks now. NVIDIA has not been $215 since June 22nd, which is crazy. But it just took a $2 hit from 214 to 212 after that Google news came out. So it is pretty confusing in terms of how the market is interpreting all this.
I don't know if I'm pretty sure you guys saw it. I know you guys have been streaming nonstop now. You guys are the streaming boys now. So you guys probably talked about this, but that news with OpenAI and Hugging Face, I thought that was crazy.
Oh my gosh, dude, you're like 3 hours late.
Yeah, obviously. I think this opened up a whole new Pandora box in AI demand. Just because, right, I think we kind of saw Pandora's box opened in the software space about 6 months ago, October, November, December, where software is completely different now because of some of those solutions. I think now we're getting to that the box has been open for cybersecurity. I can't imagine a world where we don't have selected data centers or AI infrastructure just used by AI companies to protect either national security, to protect trade secrets. And I think it's going to be crazy demand just coming from the cybersecurity market in the upcoming year or two.
To your point, Basent just tweeted about 30 minutes ago that we are not happy with China distilling these American models. So the hacking, the distillation, I mean, it looks like the administration's about to put their hand in this and see what they can do to try to protect American innovation. But I don't even know if it's really possible to stop the Chinese from doing what they're doing. Tanner, your take on not only Google, I think you are bullish even with those CapEx numbers, but let's talk a little Tesla right here. Do you have any thoughts on kind of what could happen with this name going into earnings?
Honestly, no. I've actually not kept up with Tesla over the last little bit. I'm curious to know if there's new updates on Cybercab production and when we're going to start to see some real numbers from the obviously robotaxi side of the business. That for a lot of people has been a major part of the bull case, but getting a real timeline on when we're going to see more cybercabs enter more cities and then, being turned on for, the Model Ys and stuff like this, that sort of Airbnb approach that they wanted to do. Hearing a little bit more about that and also their energy business as well. It ended up seeing a slight decline, if I remember correctly, last quarter. Do we end up seeing a big ramp up there now? Where does that end up panning out? So I'm honestly excited for both, but I only have a stake in Google today.
Yeah, Tesla's going to be really important because, at least from a perspective of, the past 7 to 8 quarters, you haven't seen meaningful revenue and EPS growth. If they even have some level of decent growth, maybe that's enough to get the stock moving because it's not at all-time highs like Google basically is. SpaceX, unfortunately, having another really bad day. It is now well below that IPO price of 135 here at 115. Maybe Tesla says something to help SpaceX sentiment, but right now, a lot of the high beta nature of SpaceX and Tesla is taking a hit. Meta, by the way, falling based on those Google potential CapEx updates. Meta right there is down about 2.84%, and then Microsoft right here, 2% as well. On top of that, you've got IBM and ServiceNow. IBM already came out a week ago and said their earnings are going to be bad, so that stock has continued to go down. ServiceNow is down because there was another software company today that said they had bad preliminary results due to IT CapEx spend or IT spend going to CapEx, which took down all the software names. Palantir took a pretty ugly hit as well at 124.50. Jose, any thoughts on kind of how the software names react to this CapEx number, or do you think it's just semis or bust when it comes to Google's CapEx?
I think for right now, it's maybe just the semis market. Hopefully, ServiceNow provides more of an indication of where that market is going. We saw IBM, I think, last week or 2 weeks ago, I forget the time frame, but kind of showcased that there might have been some weakness or delays in certain software spending due to the demand of AI infrastructure at the moment. I think ServiceNow would probably be a good indication if that was more of like an IBM problem, which I think it might be, opposed to a whole market. Now, if ServiceNow kind of goes today and kind of repeats exactly what IBM says, I think the software space could take a hit here.
Tanner, any thoughts on what happens to SaaS based on these? I mean, like, what if Google increases CapEx like crazy? Theoretically, that means the semi trade continues, which means theoretically software should go down, right?
Yeah, I don't know, man. I'm really trying to understand. I've been talking to a lot of people who've been investing in ServiceNow, and some people who are, big bulls who have changed their mind very recently on the short-term nature of these businesses, not necessarily questioning the long-term nature of ServiceNow, but just worried about this particular earnings, considering of, Pega and IBM's, or not IBM. Was it IBM that ended up doing the preliminary earnings? Is that what it was? Yeah. Yep. So I'm not necessarily playing ServiceNow. I don't. The only SaaS that I've been buying is Microsoft and Palantir, and both of those have been, honestly, I think, extremely bullish on the AI trade. Not necessarily trading that way, like Palantir's selling off today, and I think it's a great story for them. CapEx and stronger models and all of these things, and but the market will do its thing. I'm worried about the long term. For ServiceNow, I'm interested in seeing what their average contract values are per customer, if new customers are coming on board, and what's the renewal rate. Those will be the important things to see. Everything else in terms of, how much stock that they bought back or anything like this, those are smaller indications for me. What I'm really interested to see is what is the customer saying right now? And if that's strong, then the stock should go up over time.
We are getting a bit of an end-of-day sell-off right here, folks. Even the names that were really moving today, like a Nebius, Micron, they are giving up pretty much everything that they got today. So the market is definitely feeling pretty jittery before we get these Google earnings.
I have a question for you guys. I know you guys mentioned that for next year, certain analysts believe that Google's CapEx will be almost 100% growth from where we're at right now. It's only quarter two of this year. But for that side of jump, do you think management needs to share something like this quarter? Or are they, if we kind of see these type of numbers, we really won't hear it until quarter four? Because for me, if I was an investor, I would something this drastic, I would love to learn sooner before kind of getting more, before just getting the information in the last minute.
Yeah, I think they have to do it today. They have to. There's no way they can increase CapEx by 90 billion or 150 billion or something and not tell people their plan. I mean, that's the number one question they're going to get. They can't avoid that, right? So I would imagine we're going to get the answer to that. We got to keep a real big eyes. We got 1 minute till the market closes on all the semis here, because again, conventional wisdom would suggest if Google actually puts up 350 billion of CapEx, your NeoClouds, your optics, your wafers, your server racks, they should all go crazy. Memory, obviously. If that doesn't happen and they increase CapEx, that's a big question. If they decrease CapEx, that's another big question. Which I don't think is going to be happening. And then you have their RPO growth. Their RPO is at 467 billion. That doubled last Q. Does that go to like 70 billion? Does cloud go to like 80%? And is that RPO majority from OpenAI and Anthropic? Like, I think there's a lot of questions here that we're going to try to get the answers to. By the way, on the poll, 64% of you said Google will do the best on earnings compared to IBM, Tesla, and ServiceNow. We will find out in the next 20 seconds.
Yeah, I'm most hopeful about Google as well.
All right, here we go. Thank you, everybody, for being here. Lock in. We got about 3 hours. We're going to go through the Google call, Tesla call. We'll be analyzing all the numbers as soon as we get them across the board. Thank you all for being here. The stock market is now closed as we kick off big tech earnings for Q2.
Just have to sit here and tank it. Yeah.
Just to sit there and take it. That is correct. So now
it's harder to mute on this side.
Google should give you the numbers. Like, usually Google's really, Tesla takes about 5 minutes. Google tends to be pretty quick.
Yeah.
So me, Jose, and Tanner will be looking for the numbers. Whoever finds it first can just say they have the numbers and read them out. Obviously, we have IBM, ServiceNow, Texas Instruments. We're going to try to get through the big ones first and then get through all the other smaller companies that we have. Google right there ends the day at 342. S&P 500 ends the day basically flat. Micron actually ended up red, down about 1%. Palantir was down about 6%. SpaceX down 6.7%. ServiceNow was down about 6%. And then Nebius ended up about 0.5% up on the day. Tesla was down 1.3%. Okay, no numbers yet. They should be here very soon right here. Oil, by the way, also spiked up today on more claims from Trump saying that if Iran strikes any ships, we will bomb their bridges and power plants. Oil 86.62 on the day, up about 2.7%. That also was a strain on a lot of different names here today, especially in the high beta space. All right, a little bit of a green candle on Googs. We don't have Googs, but we do have Texas Instruments. Beat by 10%, 214 versus 195 on EPS. That stock is down 4. Revenue 5.4 versus 5.2. They beat by 4%. Revenue's up 23% year over year. EPS is up 52% year over year. They also were expected to do 676 million in CapEx. They're only doing 514 million, which technically I think should be good for them because they're not spending as much on CapEx.
The market, it's weird, right? I mean, it's too much CapEx bad, too little CapEx bad.
Okay, Google, we got the numbers. We have the numbers. Google is down 1%. CapEx for second quarter for Google was 44.9 billion.
Wow.
Street thought it would be 44.1, so that's a beat on CapEx. Now Google's up 2.3. Now it's green. Revenue 119.8 billion versus 117. That's a $2.8 billion beat. Operating income 40.7 billion versus 40.5. That's a beat. Services revenue 94.5 versus 94.3. That is a slight beat. Ad revenue 81.6 versus 81.1. That is a beat. Revenue's up 24% year over year. EPS is up 294% year over year. EPS came in at $9.11. The street wanted 291. That is a 213% beat. The reason I think the stock is not going to the moon on a 213% beat on EPS is because that is likely manufactured through their SpaceX and Anthropic holdings, which were re-rated. So that 200% beat on EPS is, at least right now, based on price action, the market's not caring about that at all.
That Google Cloud number is crazy, right?
Dude.
What is it? I don't have a cloud. What is it?
Oh, up 82%, sitting at 24.8 billion, but up 82% year over year.
Wow.
Oh my gosh. 950 million Gemini monthly actives. Search grew 17%. I was really hoping that would grow by over 20, but total revenue growth 24%. That's unbelievable.
I do not have the CapEx number yet for like the fiscal year, but it was 44.9. Wow. So cloud grew 82% last quarter. That was 63. Stock's flat, but that's a pretty big result of, that's a pretty big level of growth Q over Q based on the CapEx they're spending. So you're starting to see that in their cloud growth.
Yeah, last year it grew by 32%.
Right.
So we've gone from 13 billion, now year over year it's 24.7 billion.
Again,
that's wild.
That is 100% wild. For those that are wondering why the EPS beat is so big, $9 versus $2.90, it is because SpaceX and Anthropic were likely marked up. But the street is not really caring about that. It's down 1%. We'll have a lot to analyze here, but the headline numbers look amazing on Google. The beats are slight. The cloud beat is way better. It's about 2.5 billion. The other beats are very slight, but not a bad quarter at all. Tesla, let's get these numbers. We are down 1%. Revenue 28.2 versus 26.3. That's a beat. EPS 32 cents versus 33 cents. That's a miss on EPS, slight miss. Gross margin 16.8. Street wanted 19.4%. Free cash flow was negative 1.0 billion. The street thought it would be negative 3.6 billion, so that is better than expected. Alphabet gained 99 billion on their EPS based on their gain on equity. So their unrealized gains were 99 billion, which is what helped that EPS number get up there. Tesla now down 2%. It's a beat on revenue. It's a miss on EPS. It's a big miss on gross margins. And I think those are the headline numbers. We'll get energy in a second and see what they're looking at.
Well, one thing I saw with Google that I think was interesting is this is the first quarter that they are free cash flow negative.
Yeah.
Do you have the exact number on that?
About $5.8 billion is what they're in free cash flow negative right now.
Yeah. So you went from 10 billion, like, so the last couple of quarters were $24 billion in free cash flow to 10 billion to negative 5.8, 5.9 billion.
Well, they got to spend that money on these chips, right?
Yeah, free cash flow has been going down by 15 billion a quarter for the last 3 quarters.
I mean, that is something for the street to adjust to, but the street also wants the CapEx spend. We don't have the fiscal year CapEx number, guys. They might say that on the call, but we do not have that. Google right there, down after hours. Tesla down 2.5, 364. Tesla does expect Optimus production in Fremont later this year. For Tesla, EPS is down 18% year over year. Revenue is up 26% year over year. So that's a margin story if revenue is growing, but EPS is not growing. On adjusted EPS, the expectation was actually 54 cents. They came in at 33. So they missed by 40% on EPS if you look at the adjusted numbers, which is also why I think the stock is reacting badly. ServiceNow is down 1%. I do not have ServiceNow numbers. I don't think they're out yet. But that stock is down. Here's another little update real quick on Google.
119.8 billion versus 116.93 billion that was expected for Q2 revenue. Now with EPS, this is a GAAP number of $9.11. We are not comparing that to the estimate here because in the quarter, Alphabet saw a $99 billion equity securities gain. Cloud revenue, this was the big question going into the print. We are seeing an 82% jump year over year to 24.8 billion versus the $22.24 billion that was expected for cloud revenue. And I've also got to read on CapEx in Q2, 44.92 billion, also beating the estimate there. I'm going to keep digging into these numbers and come back to you guys.
Tanner, raw thoughts, Google, decent quarter?
Yeah, I actually don't think this is too bad. The free cash flow, I think, is something to absolutely worry about, but we kind of knew that this was going to come, and it's only going to get worse if we end up seeing these estimates come to light. Like, Meta can't continue to stay free cash flow positive. Google can't continue to stay free cash flow positive if we expect CapEx to roughly double year over year. Well, that's going to be very hard. And Microsoft, actually, funny enough, has a little bit of a buffer because they're still doing buybacks and they're still doing, large dividends. But you'll likely see them also look to potentially slow down the buybacks and increase the build out if they can continue to see this high margin growth in cloud. So one of the things that I think was misconstrued, or some people were talking about, is that the new data centers are less profitable than the old data centers. And here, Google Cloud is posting operating income, saying that on 32% growth, they had a 20% operating margin for Google Cloud. Today, they're growing by 82% at a 35.6%, the highest ever posted operating margin for Google Cloud. So they want to focus on this because it's one of the most profitable businesses. You can see that on this slide here. So I don't know. It's quite interesting. On the operating margin, you can see year over year here.
Yeah, that's a 15% increase year over year, which means they are finding a way to actually monetize that cloud business in a meaningful way. IBM, those numbers are out. Obviously, the stock is down 40% from last week based on the preliminary numbers. Their revenue was in line, 17.2 versus 17.1, EPS 293 versus 293. ServiceNow, are we up on ServiceNow? Nothing too crazy on IBM. ServiceNow getting a 3% move. It was down 6% today, so if it can go up 6% after hours, we'll break even. I do not have the numbers. Yes, I do. Second quarter revenue, $3.99 billion versus $3.93. That's a beat. They're also raising. They are raising. I don't like dried grapes, but they are raising their fiscal year 2026 subscription revenue guidance. I mean, that's nice to see a software company actually raise their guidance versus take it down for a change. Can we get over 100? Can we stay over 100? Trying to get the EPS numbers, but at least so far, this looks a bit more positive. ServiceNow, okay, 5% beat on EPS, 90 cents versus 86 cents. So that is a beat, not massive, but still a beat. And then you got the revenue beat, 3.9 versus 3.93. Revenue's up 24% year over year. I mean, that's not bad growth by any sense of the imagination. EPS is up 10% year over year. I don't know if they let this thing run. Yeah, I don't know if they let this thing run on a day where software is ugly, but the numbers aren't horrible. The numbers aren't bad. I mean, they're raising guidance. That's not IBM is taking away guidance by like 30%. ServiceNow is raising it.
Such a good raisin joke. You didn't get enough credit?
Well,
me and Jose loved it.
I might have used it in
I
the
did.
past. So some people have already heard it, but for the new people here, it was worth doing it again. ServiceNow 2.4 is Palantir up after hours. Palantir is up after hours just a little. Google's basically flat. Tesla is still down 2.3. Google was down about 1.5, and now it's flipping slightly green. Tesla's not really flipping at all. 363 on Tesla. IBM up 4. I mean, maybe the worst was priced in for IBM. I mean, stock was down 45%. as ServiceNow tries to get up a little bit more, 4% on ServiceNow.
Do you think Google is going to even talk about their full year CapEx, or do you think it's going to get to a part where they just stop sharing it because they know it's going to sell them off? It's almost like whenever, you know, your subscriptions for next year are going to go down, so you stop guiding.
Well, I don't know why the buy side came out with estimates if they were not going to get the answers today.
The only thing I would say, maybe if they just think it's going to be higher than what they say today, they don't want to keep raising it every quarter. So if that could be another reason if they don't say anything, because
that is fair. Let's get a little bit more analysis on Google, and then we'll get deeper into some of these other earnings.
Likely at more than 70 billion run rate 6 or 7 months later. Guess what? Google and Amazon are their big compute providers. So that's flowing through. And I'm guessing that the securities gain has to do either with the stake in Anthropic or SpaceX.
Exactly.
Two very good investments for Alphabet over the years.
Yes, for sure.
Yeah. Brent, what will you be, we're all coming through the numbers at this point, but what will you be looking at to sort of glean whether that return on investment metric can be found in this release?
Well, you're not going to find in this release, so let's not focus on that. But when you look at cloud, right, I think as Gil said, you know, the 10% beat on cloud was massive. The Whisper number was 75. The street was at 65. So 82 is a 10% beat. Search is in line at 17% growth, and YouTube beat by 2.5%. CapEx is basically right in line, 44.9 versus street at 44.7. So the only thing I'm seeing on the numbers is margin is a little bit lower for 39 versus the street at 40. But when you look at the cloud beat, look at search in line, YouTube beating by 3, CapEx, you know, right in line. It felt like it was right down the middle. It was stable, steady. I think the market was hoping for more. But you know, look, it was call it a 260-yard drive. It was not a 300-yard drive that we've seen from them in the past. So it was.
And Google basically not reacting that much on the. I mean, we were talking about this in the morning. I don't think it would have surprised people for the stock to be relatively flat. It's up a nice 1.4% after being down 2.3. But that's kind of what you want, right? You don't need it to go up like crazy. You also don't need this to tank. The numbers seem to be good enough to justify the current price, at least that it's at right now.
Sorry, I was just going to say, what do we need them to say in earnings in order to bring this stock up? Because like growth on cloud, 82%. What level would justify the CapEx spend that would make investors happy?
Jose, you're the expert on this.
I don't know what investor sentiment feels like. To me, 82% is more than enough to tell me, hey, I'm going to keep increasing CapEx. If we continue to see these numbers, right? Last quarter, I think we discussed it was 60 something percent. You're seeing an acceleration of a much larger number. So I think they should keep spending. The thing that I found the most shocking was I knew Google was going to end up being free cash flow negative. I just didn't think it was going to be this quickly. I wonder how the market is going to react, because this was one of the stronger ones. When like Amazon reports this quarter, or when Microsoft reports this quarter, which I do believe tend to have a lot lower free cash flow than Google. So if Google is doing it like this, it's going to be interesting to see how the other players are playing it out.
I see some comments and people are saying, you know, if they cut CapEx, then the stock would moon. But would the long-term Google investors in chat actually want that? Like, would you want them to potentially concede their position in cloud to more of Microsoft and more of AWS and the other companies who are not cutting CapEx? Because there is that demand for artificial intelligence. We're seeing these cloud companies, as you can see from the 82% growth. What was the backlog? Did we see the backlog update yet?
Let me check. We have to have it somewhere. Let's see.
You know, like, do you really want them to concede this business? A business that has been extremely fruitful for them. So of course you want higher free cash flow, but you can't have your cake and eat it too.
Yeah, I mean, also if they stop spending on CapEx, what if they're like, part of the reason they're growing 82% is because they can supply all the demand, and to supply the demand, you have to spend on CapEx. So if they stop the CapEx, maybe they can still supply the demand with the current amount of capex they're spending, but theoretically, if they can't, and that's what management has told us for the past year and a half, they wouldn't be growing like this, right? Which is the issue.
Yeah, if they don't increase capex and they focus on buybacks and all those types of things, essentially what you're buying is Apple. Like that's the, sort of company that you would replicate.
Right. I do not have these. Hold on. Do I have it? RPO.
I didn't see it. I don't know if I missed it though.
Did they not disclose RPO? Because that would be pretty annoying if they didn't. Just to give everyone some stats. So Gemini, 950 million MAUs, 22 billion Gemini API tokens per minute is what they're processing. 198,000 employees. Operating loss of negative 5.8 billion. Operating income on cloud of 8.8 billion. Sundar Pichai said Q2 was an amazing quarter. It's great to see wide adoption of Gemini Enterprise. We are seeing strong demand for our security solutions. They acquired Wiz for 32 billion last year. Cybersecurity. These outstanding results show that our differentiated full stack approach to AI is delivering real measurable value for consumers, customers, and partners globally. They have 98 billion of debt, 242 billion of cash, 53 billion of TTM free cash flow, negative 5.9 billion free cash flow for this quarter. I do not see RPO.
I think one thing I would love to hear, and I think the answer is going to be yes, but love to hear Google say that we grew cloud by 82%, and everything is still running at 100% utilization rate, right? There's still so much, everything revenue, as soon as the GPUs are turning on, they're being sold off. Any commentary like that, I think would help kind of build that case of why CapEx continues to grow and why the company's free cash flow. I think that's the case. I think probably many of us here believe that's the case. But for them to just kind of announce that to the investing world again, I think can help solidify a little bit of this CapEx spending.
82% after growing 32% or whatever it is says a lot of that. But go ahead.
A lot of you guys are saying 514 billion is the backlog. I did not see that, but a lot of you are saying it. We'll try to confirm it, but if that's the case, that's a big
that lines up well. That would make sense.
Yeah, and there's no reason they wouldn't disclose it. They do it every quarter, so I imagine that could be up there. By the way, ServiceNow, baby. 102. Let me give you guys some ServiceNow numbers. I've got more of them. So subscription revenue up 23%, total revenue up 24%. The guide has been increased. Gross margin on subscriptions 81%, operating margins 31%. Their free cash flow margin 35%. Bill McDermott. Once again, we beat the high end of our guidance range across every top line and profitability metric in an environment where most enterprises are still searching for AI's ROI. ServiceNow is the platform delivering it. With our AI control tower as the market standard, agentic deployments of ServiceNow increased 9-fold in just 9 months. Our 29 billion in RPO is fueled by longer customer commitments and skyrocketing demand from our partner ecosystem. I mean, I don't see anything wrong with these ServiceNow numbers. I don't know if the market's going to let it stay above 100, but I mean, it definitely shouldn't go back to the 85s like it did last time, hopefully.
I think Chris said that he wanted to talk about.
Yeah, guys, we will have Chris on after we have the Google call in like 10 minutes. So I'm sure if we're talking to Chris, it will be longer than 10 minutes. So if he's here after the call, we can get him on and talk to him. But I mean, look, ServiceNow fell 6% during the day. You kind of had to think, look, is this really going to fall another 6% if the numbers are good? And the numbers are pretty good. It's not like phenomenal, but it's definitely not like horrible numbers like IBM. So, theoretically, the stock should be getting at least somewhat of a boost, which is what we're seeing. In terms of Tesla, some updates here. Tesla says Optimus first generation production lines are being installed. Mega Factory Texas nearing completion within production this year. Robotaxi is now live in 7 major U.S. metros, and Tesla Semi and Megapack 3 on schedule for 2026 production. They also hold a SpaceX stake that added $1 billion of 22 cents of their non-GAAP EPS was SpaceX equity. They only brought in 39 cents of EPS or 33 cents of EPS. So you're talking about more than 50% of their EPS was because of their SpaceX stake.
Is it all SpaceX or is any of that Anthropic?
Well, SpaceX, Tesla doesn't own stake in Anthropic, but for Google, yes, it is Anthropic and SpaceX.
Oh, sorry. I thought you were talking about Google. No?
No, Google. So Google, for those that are asking that are confused about their EPS, $9.11 of EPS $2.93 expected. So that's $7 deltas because of Anthropic and SpaceX. For Tesla, 33 cents of EPS, 22 cents of that was SpaceX.
Okay. Sorry, my bad.
Yeah, so obviously it was a lot more for Tessie. Jose, I'm assuming you like the Google numbers. You're not too concerned about it, right?
No, I love the Google numbers. So, I mean, cloud growth, seeing massive demand. I think it just tells us the AI story continues. What I did find interesting, I was just looking at X, and Semi-Analysis posted something where they noticed that Google now posts in the Google Cloud revenue segment, it mentions that Google Cloud generally makes revenue from sales of TPU systems. And I was just kind of trying to see if this is new wording that is being used. And yes, AI is confirming that this is new wording. The actual phrase was Google Cloud generates product revenues primarily from the sales of TPU systems. And that's not something.
Do you think they will ever disclose how much the TPUs make for them, or would they not want to do that?
I don't know. I mean, Amazon does it a lot, right? I think Amazon has given us both what their annual run rate is when renting out the chips, and also now they're talking about how much they would make if they were to sell the chips. I would love to hear some, and I don't think it's impossible not to hear it. It's not impossible for them to say it either.
But this isn't internal sales. They're just saying that the compute that is from TPU? Or are you saying...
I think they're talking about... Well, technically, yeah, it might be compute coming from the TPU versus selling the TPU, right?
Yeah, because I've not seen any... there would have been press releases about that, right?
Right. That's true.
Like other cloud service providers buying TPUs.
Maybe it's a combination of both. I mean, they don't separate it, right? So we don't actually know. But
yeah,
they are starting to include that now. ServiceNow still getting a nice 5.8% move after hours. Let's get another update on Googs and Tesla. And then in 6 minutes, we start the Google call.
Category, which is a key read both on the ad market, but whether their generative AI business is cannibalizing what still remains their core revenue and profit engine. That segment came in a bit light of estimates at $63.3 billion versus the $63.42 billion expected. YouTube revenue actually breaking a losing streak here in terms of missing the street's expectations. That's coming in at $11.1 billion, which is a beat over the $10.81 billion expected. Notably, I am not seeing backlog in the release like we did last quarter. Remember, last quarter it had doubled to $460 billion, so they're not singling that out this time. You might get that on the call. Only other thing I would point to is that other bets revenue. This is the segment where Waymo lives. It's again a miss, just like it was last quarter, coming in at $382 million versus the $401.3 million expected. And Google doesn't offer formal guidance. We should get more color on the call, which kicks off in about 20 minutes from now.
A little bit more here on ServiceNow as well, or Tesla than ServiceNow.
EPS of 33 cents a share. The street was expecting 51 cents a share. We're going to dig through the numbers to explain exactly how that happened. Revenue came in better than expected at $28.24 billion. The street was expecting $25.7 billion. A couple of numbers within the numbers from Tesla in the second quarter. $3.12 billion was the revenue from energy storage. I know the street was expecting 3.5 or a little over 3.5 billion. FSD subscriptions, full self-driving subscriptions, they give a cumulative number every quarter. It's 1.48 million for 2Q. That's up 200,000 compared to 1.28 million at the end of Q1. CapEx spending came in at 5.78 billion, shy of what the street was expecting at 6.5 billion, and free cash flow negative 1.09 billion. A couple of things.
Again, street thought it would be negative 3.5 billion, so that actually was a bit better than some of the expectations.
With ServiceNow CEO Bill McDermott, and he spoke specifically about the growth that they're seeing in cybersecurity. Wanted to point that out. He said, we're now the fastest growing cybersecurity company in the world in enterprise software, and we're now the 8th largest cybersecurity company in the enterprise.
You're muted, brother.
Sorry, I thought it was a professional. I said this is a big deal because the only companies that have diverged from the software companies this year have been the cybersecurity companies. So the fact that Bill McDermott is saying, hey, don't forget about us as a SaaS company that has now a cybersecurity acquisition that is also giving us the 8th largest cybersecurity enterprise software application in the world. I mean, that in and of itself should hopefully help some of the sentiment, especially if that continues to grow at the level it's growing at going into the end of 2026.
We talked about what's been happening in the AI space, this Hugging Face OpenAI stuff. He said, hey, we would have been able to prevent that with our control tower. I asked him about M&A. He said they're growing organically at this point in cybersecurity after the acquisitions that they've already done, but might do a tuck-in here or there. But really also wanted to point at the guide here. Now, there was a little kind of numerical issue that investors will note on there's a pull forward in the federal. He said, don't pay too much attention to that. That's just really an accounting blip in there. The thing to pay attention to from his perspective is that they're raising in their confidence on the demand for their AI business. ServiceNow AI has really crossed that $1 billion ACV run rate and is continuing to go beyond that. And I asked him specifically about, okay, this shift in spend within the enterprise away from some companies toward AI infrastructure. Why isn't ServiceNow getting hit by that? He said he continues to see and believe that they're really in the bullseye of where customers want to be and being able to control their AI spend. And
absolutely love it. That's the right answer, right? He's like, don't group us in with IBM. We're not with those guys. We matter. I'm sitting with Jensen at my conference. Like, we matter. We're the AI software play. So, I mean, that's what you needed.
Yeah.
For Bill McDermott.
I didn't know they made a cybersecurity acquisition. Is this old or?
It happened. It happened 3 months ago, and that's what hurt their margins last quarter, right? But
that's actually pretty interesting. I got to look at this one then.
All right, we got the call in a minute. Jose, Tanner, I'll ask you this question. If you were an analyst on the call, now that you have some of these numbers and in the chat as well, what would you ask Mr. Sundar Pichai?
Oh my gosh. I'm not sure. I think I would just continue to talk about or continue to ask about, do you expect margin to continue to expand with this backlog? How large is your new chip business going to be? I think those would be, if you want to sell chips externally, I think those are two of the biggest opportunities, is cloud and selling TPUs externally.
And for me, I would ask if what they think is the biggest market grower in AI. Is it coding? And what do they think is the next big thing? I would love to hear their thoughts if cybersecurity is the next thing, or if coding is just going to continue to be the main driver for AI growth.
Okay, now let me warn everybody. I have to do this every time. The Google call is boring until we get to the questions. Just being honest.
It's not that bad.
What do you say?
I said it's not that bad. I enjoy it.
Well, when the CFO starts talking, it's 20 minutes of pure reading off of a script. So just be ready for it. It is what it is. But once we get to the questions, we can, get to some of the good stuff. All right, I think we are live. Here we go. Google, and then we'll be back after Google, and we will get into Tesla. And we'll keep some updates in the chat based on the other companies that are reporting.
Good luck, everyone.
To ask a question during the session, you will need to press *1 on your telephone. I would now like to hand the conference over to your speaker today, Jim Friedland, Head of Investor Relations. Please go ahead.
Thank you. Good afternoon, everyone, and welcome to Alphabet's second quarter 2026 earnings conference call. With us today are Sundar Pichai, Philipp Schindler, and Anat Ashkenazi. Now, I'll quickly cover the safe harbor. Some of the statements that we make today regarding our business, operations, and financial performance may be considered forward-looking. Such statements are based on current expectations and assumptions that are subject to a number of risks and uncertainties. Actual results could differ materially. Please refer to our Forms 10-K and 10-Q, including the risk factors. We undertake no obligation to update any forward-looking statement. During this call, we will present both GAAP and non-GAAP financial measures. A reconciliation of non-GAAP to GAAP measures is included in today's earnings press release, which is distributed and available to the public through our investor relations website located at abc.xyz/investor. Our comments will be on year-over-year comparisons unless we state otherwise. And now, I'll turn the call over to Sundar.
Hi, everyone. Thanks for joining us. We have exciting momentum. Alphabet revenue grew 24% year over year. our AI investments are redefining what's possible across every part of our business. Our momentum starts with search, where people are adopting one seamless search experience across AI overviews and AI mode. We saw 17% revenue growth in search and other, and YouTube ads grew 13%. Cloud revenue grew 82%, powered by strong demand for AI infrastructure and AI solutions. And cloud backlog grew to $514 billion. It's great to see the wide adoption of Gemini Enterprise, with nearly 90% of Fortune 100 using it. Today, I'll expand on our AI progress, our global product footprint led by Search and YouTube, Google Cloud's leadership, and our long-term bets. First, AI. Yesterday, we announced new models, Gemini 3.6 Flash and 3.5 Flash Lite, which are cost-effective and highly efficient. We are seeing tons of demand for our workhorse Gemini Flash series because it hits the sweet spot of performance and cost. We also launched Gemini 3.5 Flash Cyber, which I'm really excited about. Paired with our CodeMender agent, it finds and fixes vulnerabilities and delivers performance at the frontier, comparable to far bigger cyber models. Gemini 3.5 Pro is currently in testing, and our team is already building the next generation of models. We have started our most ambitious pre-training run yet for Gemini 4 and are excited by the progress we are seeing at the frontier. Demand for our models is translating to strong token usage across developers and enterprise customers, and we continue to be supply constrained, a sign of momentum and rapid adoption. More than 9 million developers are building each month with our models across our APIs and key developer products. Our model APIs are now processing approximately 22 billion tokens per minute. That's up from 16 billion just a quarter ago. Additionally, this quarter, we launched Omni. It allows users to create anything from any input, starting with video. Since launching at I/O in May, there's been a 40% increase in daily active users creating videos on the Gemini app. Our Gemma family of open models, small enough to run on local devices, are hugely popular. These models have been downloaded over 900 million times, and our latest Gemma 4 models have been downloaded over 300 million times since launching in April. Our agentic development platform, Antigravity, allows anyone to build in the agent-first era. It has more than 2.4 million weekly active users. Antigravity is a powerful tool for users and enterprises, and it's completely accelerated how we build internally. As just one example, a team in Chrome is now on track to accelerate delivery by 8 times, compressing a 2-year timeline into 3 months through model-driven refactoring. Moving on to our global product footprint, which brings AI to more people than any other company. Starting with search, AI continues to drive an expansionary moment, with new experiences resonating with users and driving growth in queries. As a big football fan, I was particularly excited to see search usage hit an all-time high during the World Cup this year. This really highlights how much people turn to Google in moments that matter. We continue to make search more helpful and intuitive. We recently brought together AI overviews and AI mode into one seamless search experience that combines our frontier capabilities with the best of the web. And we are continuing to incorporate more frontier capabilities into search with agents, personal intelligence, and notebooks. Our AI-powered features are driving increased search usage. Since expanding AI mode globally last October, we have surpassed 1 billion monthly active users. And just like AI overviews, AI mode is driving an incremental increase in search queries overall, and we are now sending billions of clicks to websites every week through AI features in search. As we serve more of these queries, we've continued to drive efficiencies. Thanks to our engineering and hardware optimizations, this quarter we reduced the cost of AI mode responses to its lowest level since launch, even as we have brought more advanced AI capabilities. Philip will also talk more about how we are innovating the ads experience. Next, the Gemini app, which now has 950 million monthly active users, with daily active users tripling in the last year. Users love new agentic features like Daily Brief and our personalized agent, Gemini Spark, which is now available in the US and internationally. We've been shipping helpful new features like this at an incredible clip. On to YouTube. Month after month, when a big event happens in the world turns to YouTube. It's been incredible to see that over 1.7 billion unique viewers globally watched World Cup-related videos on YouTube during the FIFA World Cup 2026. We're also bringing the power of conversational AI directly into the YouTube experience. Ask YouTube uses our Gemini models to let people ask complex questions about individual videos, get quick takeaways, and jump straight to moments in those videos. The early engagement is encouraging. More than 140 million users engaged with Ask YouTube on the watch page in June 2026. And we are bringing that Ask experience to the wider search experience on YouTube. Next, cloud. Our continued momentum is driven by our integrated AI portfolio consisting of chips, models, data, security, and agent platforms, all designed to work together. Gemini continues to be a key driver of growth and is deeply integrated across all of our cloud products, including Gemini Enterprise, data analytics, cybersecurity, and Google Workspace. We are seeing strong, diversified demand across products, customers, geographies, and industries. Our product differentiation is driving expansion in 3 ways. We are winning new customers, more than doubling our acquisition velocity year over year. We are deepening our relationships with existing customers who are expanding their usage and exceeding their commitments by more than 50%. Also, an acceleration over last quarter. We are driving growth with partners, with transactions on Google Cloud Marketplace growing over 7 times year over year. One of the strongest parts of our growth comes from the rapid adoption of our Gemini Enterprise platform. It's differentiated with easy-to-use tools to build agents and automate processes, connectivity to enterprise systems, cost management, and governance tools. In Q2, Agent Development Kit, our framework for building and deploying enterprise AI agents, reached nearly 70 million total downloads. As I said, nearly 90% of Fortune 100 are using Gemini Enterprise. We have customers like PepsiCo for AI and analytics solutions, Intel to streamline core processes, HSBC for wealth management, Bell Canada for customer engagement, Macy's for commerce experiences, and Signal Iduna for knowledge management. More broadly, Gemini is transforming how millions of businesses use AI to build custom agents, automate processes, improve cybersecurity, manage customer relationships, streamline data analytics, collaborate effectively, and more. All of this momentum is driving growth in our paid token usage. Nearly 500 cloud customers have each processed more than 1 trillion tokens in the last year, and usage is so much deeper than that. Over the last 12 months, more than 2,000 enterprises consumed over 100 billion tokens. We're also seeing strong interest in our AI-powered security platform, which is differentiated because it integrates threat intelligence, cyber response prioritization with Wiz, AI automated scanning, code remediation, and monitoring. Today, 90% of Fortune 100 are Google Cloud security users. Nearly 90% of Wiz customers are using AI-powered security features. And we have seen a more than 45% quarter-over-quarter increase in the number of AI workloads scanned and protected by our security platform. Our security tools are being used to protect critical infrastructure, including financial services organizations such as Morgan Stanley, telecommunication providers such as TELUS, healthcare organizations such as Texas Children's, software companies such as Atlassian, and several government agencies. And with our new Google AI Threat Defense, we are really excited to bring our new cyber model and CodeMender to help our customers defend against AI threats. All of this is powered by our leading AI infrastructure. We offer the industry's broadest range of accelerators from Google and NVIDIA, including the new NVIDIA Vera Rubin platform and TPU 8T and 8i, which delivers strong price performance. On top of this, let me mention 3 unique offerings. First, our Virgo network, which is designed to meet the needs of modern large-scale AI workloads. It allows customers to connect 1 million AI accelerators across multiple data center sites into a unified supercomputer. Second, our software stack has native support for JAX, PyTorch, vLLM, and SGLang, enabling workload portability across GPUs and TPUs. And third, our new agent-optimized Axion CPU provides 30% better performance per dollar compared to peer offerings. We are seeing strong growth in demand for our AI infrastructure offerings from leading labs such as Ineffable Intelligence, next-generation AI builders, including Kakao, financial services like Deutsche Börse Group, pharmaceutical companies such as Pfizer and Roche, and robotics and spatial intelligence companies such as World Labs. We are continuing our strategy of investing in promising companies and internal efforts that bring pioneering AI research into the real world. We have seen exciting progress from our other bets. Waymo introduced its newest vehicle, Ojai, to public riders. This is the first vehicle powered by the 6th-generation Waymo driver and will welcome more riders in the coming months. Wing has safely completed more than 1 million home deliveries, and we continue to grow our presence through partnerships with Walmart, DoorDash, and Papa John's. In health and drug discovery, Isomorphic Labs raised over $2 billion to power its AI drug design engine, scale globally, and advance its drug candidate pipeline. It's truly been an extraordinary first half of 2026, with much more to come. Thanks to all of our employees and partners worldwide for their incredible work this quarter. With that, Philip, over to you.
Thanks, Sundar, and hello, everyone. I'll start with a review of Google Services, highlighting our momentum across search, YouTube, and partnerships. Google Services revenues were $95 billion for the quarter, up 15% year-on-year, primarily driven by search. Search and other delivered 17% growth, with retail and finance driving the largest contributions. YouTube advertising revenues grew 13%, driven by direct response and brand. Network advertising revenues were down 1% year-on-year. Strong performance in search and YouTube underscores how our investments in AI translate into measurable value for our users and advertisers. Starting with search and other. Revenues reached over $63 billion for the quarter. Sundar highlighted the momentum we see in search, which directly impacts our advertising business. We continue to accelerate the deployment of Gemini across our entire ads infrastructure to boost performance in 3 areas mentioned before: ads quality, advertiser tools, and AI user experiences. First, ads quality. At Google Marketing Live, we showcased how Gemini improves query understanding, allowing us to find relevant ads for longer searches previously difficult to monetize. The core engine of our search ads relies on a dual prediction, delivering immediate utility for the user while maximizing measurable value for the advertiser. Gemini completely supercharges this capability. We use Gemini's advanced reasoning to decode the nuances of longer, more detailed queries. With shopping ads, for instance, we drove a 20% improvement in showing highly relevant ads, helping shoppers immediately find the best match. Second, advertiser tools. Take AI Max. It has become the core building block for advertisers to fully participate in our new AI experiences. It's out of beta, and 500,000 advertisers have already adopted it. Those who adopt our AI-powered campaigns like AI Max or PMax see an average of 15% more conversions or value on search at a similar ROAS. AAA Auto Club enterprises used AI Max to personalize creative assets and capture growth from increasingly detailed insurance searches. This led to a 17% improvement in conversion volume and an 11% decrease in cost per lead. We see strong adoption of our generative AI creative tools, which makes creative development easier, especially for SMBs. In fact, over half of our SMB customers globally use AI to create or optimize their creatives. Third, new AI user experiences. At I/O, we showed how search, including AI overviews and AI mode, works as one connected experience. As you saw from our results, our performance across this holistic system is robust. We continue to be encouraged with monetization performance on queries that show AI overviews, even as we've expanded AI overviews to more commercial queries. Across AI overviews and AI mode, people are asking more specific and detailed questions, providing opportunities for more relevant ads. Within AI mode, we continue to test and deploy a range of new ad formats. For text ads, we improved performance by adding contextual site links based on the conversation. Direct offers is gaining momentum with partners like IHG Hotels and Resorts soon surfacing special offers during trip planning. In highlighted answers, our latest experience, placing clearly marked sponsored links inside list responses, is showing early user traction. Looking at commerce. In collaboration with the retail industry, we established the Open Source Universal Commerce Protocol, UCP, as the new standard for agentic commerce. Merchants are rapidly adopting UCP, with Target and Steve Madden now live, while new members have joined the UCP Shopping and Food Tech Councils to help steer its vision. We also announced Universal Cart, allowing shoppers to add items from different retailers across Google services and buy in a single checkout. Now onto YouTube. As a FIFA preferred platform partner, we help fans around the world tune into the games. As Sundar mentioned, over 1.7 billion unique viewers watched World Cup related videos and over 550 million watched them on their televisions. This made the FIFA World Cup 2026 the most viewed World Cup in YouTube history. Advertisers connected with fans through FIFA channel takeovers, Gemini-powered soccer-themed sponsorships, and game day mastheads. And, of course, a huge congratulations to Spain for taking home the trophy. More broadly, on YouTube, we introduced an exclusive slate of creator shows, making it easier for brands to tap into the fandom of creators. We launched custom sponsorships to put brands at the heart of the world's biggest moments as they unfold on YouTube, using AI to dynamically surface videos tailored to a brand's desired moment. Brands continue to partner with YouTube creators to engage new audiences. Kate Spade reached Gen Z through a first-of-its-kind YouTube creator campaign and partnered with creators Ellie Thuman and Hannah Meloche. By leveraging multiple format videos on YouTube, the brand drove a 3.25% brand lift in purchase intent. This unique convergence of brand equity and commercial action makes YouTube a powerful full-funnel platform. SMBs continue to fuel our direct response growth through campaigns like Demand Gen. They leverage our AI to scale visual storytelling across YouTube, Shorts, and now Google Maps. To attract high-value shoppers across North America and Europe, outdoor brand Arc'teryx used Demand Gen to achieve a 70% better return on their ad spend compared to other paid channels. Looking at monetization across YouTube, we're driving sustained growth across our key priorities. In the living room, we see continued momentum across both brand and direct response. With the launch of Buy with Google Pay, viewers can complete purchases directly on their CTV, turning the TV screen into a stronger performance surface. Shorts continues to deliver high-performing opportunities for social and video buyers alike. Beyond advertising, YouTube subscription business, which thrives across living room screens, is growing faster than ads, particularly driven by YouTube Music and Premium. Internally, we leverage Gemini to transform how we work and how we serve our customers. 83% of our sales team uses Gemini-assisted tools weekly, driving up to a 20% higher win rate when using customized pitch narratives. Our ads customer support teams use Gemini-powered agentic solutions that now autonomously address 75% of support queries, freeing them to solve our customers' most complex challenges. Similarly, our new agentic solutions for SMBs have expanded our reach by hundreds of thousands of new customers year to date. As always, ending with partnerships. We're seeing more businesses benefit from the unified strength of Google's AI stack. Booking Holdings expanded a multi-year cloud commitment and are partnering closely to advance our AI-powered ad formats. It's also deploying Google's AI technology to enable new customer experiences like agentic dining reservations on OpenTable, helping restaurants get discovered and booked right when it matters most. In closing, I'd like to thank Googlers everywhere for their contributions to our success and our customers and partners for their continued trust. Anat, over to you.
Thank you, Philip. My comments will focus on year-over-year comparisons for the second quarter, unless I state otherwise. I will start with results at the Alphabet level and will then cover our segment's result. I'll end with some commentary on our outlook for the third quarter and full year 2026. We had an outstanding second quarter, delivering our 12th consecutive quarter of double-digit revenue growth. Consolidated revenues were $119.8 billion, up 24% or 23% in constant currency. Total cost of revenues was $45.9 billion, up 18%. Tech was $16.2 billion, up 10%. Other cost of revenues was $29.8 billion, up.
Okay, so questions. ServiceNow starts in 3 minutes. I believe the CFO is going to be talking for the next 15 about the numbers, which, again, she's just reading the numbers off of the press release. We can listen to the first 5-10 minutes of ServiceNow, then get right back to Google for questions. Let me know what you guys think. Or do we just want to listen to her read the numbers? But we could switch for like 10 minutes and then get back before questions.
Sales and marketing expenses were up 18% due to investments to support the Gemini app and search and compensation. And G&A expenses increased 24%, primarily driven by compensation and charges for certain legal and other matters. Operating income increased 30% to $40.8 billion, and operating margin was 34%. Other income and expenses was $98 billion, representing a substantial increase from the prior year, primarily due to unrealized gains in our equities securities portfolio. Net income and earnings per share increased significantly, primarily due to the unrealized gains in OI&E I just mentioned. We generated strong operating cash flow of $39.1 billion in the second quarter and $185.7 billion for the trailing 12 months. CapEx was $44.9 billion in the second quarter, with the vast majority of the spend in technical infrastructure to support our investments in AI. Approximately 60% of our investment in technical infrastructure this quarter was in servers, and 40% was in data centers and networking equipment. We had negative free cash flow of $5.9 billion in the second quarter, driven by our investments in CapEx. Free cash flow was $53.3 billion for the trailing 12 months. We ended the quarter with $242.5 billion in cash and marketable securities, which includes $87.1 billion of marketable equity securities. Long-term debt was $98.2 billion. And as mentioned in our press release, our board of directors declared a quarterly cash dividend on our common stock of 22 cents per share, which is payable in September. Turning to segment results, Google Services revenues increased 15% to $94.5 billion, reflecting strong growth in search and subscriptions. Total advertising revenues were up 14%, with growth across all major verticals. We experienced strong ad growth related to the World Cup, particularly in YouTube ads. Google Search and other advertising revenues increased by 17% to $63.3 billion, with retail and finance driving the largest contributions. YouTube advertising revenues increased 13% to $11.1 billion, driven by direct response advertising, as well as brand, with strength in the living room, as Philip mentioned earlier. Network advertising revenues of $7.3 billion were down 1%. Subscription, platforms, and devices revenues increased 15% this quarter to $12.9 billion due to strong growth in both YouTube subscriptions, particularly YouTube Music and Premium, and Google One, which was driven by demand for AI plans. Google Services operating income increased 20% to $39.5 billion, and operating margin was 41.8%. The Google Cloud segment delivered outstanding results in the second quarter, driven by our enterprise AI products and services. Cloud revenues were up 82% to $24.8 billion, driven primarily by GCP, which grew faster than cloud overall. Core GCP, AI solutions, and AI infrastructure were all important drivers of growth. We also began to recognize revenues from TPU system sales, which we delivered to customer data centers for the first time in Q2. Cloud revenue growth accelerated meaningfully even after excluding the impact of TPU system sales. Cloud operating income was $8.8 billion, more than tripling year over year, and operating margin increased from 20.7% in the second quarter last year to 35.6%. Google Cloud's backlog increased by more than $50 billion sequentially, reaching $514 billion in the second quarter. The increase was driven by strong demand for our enterprise AI offerings. The majority of the backlog is related to typical GCP contracts from a broad mix of customers, and we expect to recognize just over 50% of the total backlog as revenue over the next 24 months. In Other Bets, revenues were $382 million, and operating loss was $1.8 billion as we continue to expand Waymo's business and invest in key Other Bets. And in Alphabet level activities, the operating loss was $5.8 billion, driven by shared AI R&D expenses. Turning to our outlook and business performance expectations in the second half of 2026. First, in terms of revenues, at the current spot rates, we would expect a slight FX headwind to our consolidated revenue in Q3 compared to a 1 percentage point FX tailwind in Q2. This impact will be seen primarily in search and YouTube ads. In Google Services, as Philipp mentioned, we continue to benefit from innovation in search by improving the user and advertiser experience with AI. At the same time, in Q3, we will begin lapping an acceleration in search performance that began in the third quarter last year. In Google Cloud, we're seeing significant demand for products and services, which we expect to drive strong growth. As I mentioned earlier, we started delivering TPU system to customer data centers in the second quarter. We continue to expect to recognize a relatively small portion of the revenues from our existing TPU system sales agreements this year, ramping as we exit 2026. We anticipate the vast majority of the revenues from these agreements will be realized in 2027. And given the supply-constrained environment, we plan to expand the use of third-party capacity in Q3 as a bridging strategy while we build out more internal capacity. This strategy allows us to keep growing our customer base and capture greater overall value. However, it will create modest margin pressure in the near term as we utilize this capacity. Moving to investments, we are updating our full year 2026 CapEx guidance range to $195 to $205 billion, up from our previous estimate of $180 to $190 billion.
That's an increase of $10 billion for 2026 CapEx.
The increase in the range is primarily due to an acceleration in the delivery of capacity to meet growing demand. As we previously shared, we continue to expect our CapEx to increase significantly in 2027, and we'll provide more details at a later date.
No 2027 CapEx. 2026 is an increase from 190 to 205, so about 10 to 15 billion.
They did say significant increase, though.
They did say significant, which means maybe we're heading to 250, 300 for 2027, but they are not.
They also said this. They also said the third quarter they're going to expand a lot of other players, so neocloud companies should probably benefit next quarter.
Oh wow, guys, the stock's tanking. Oh my. I guess the street didn't like another 15 billion. So hold on, the street doesn't like 15 billion of CapEx. What are they going to do when it's 70 billion of CapEx in 2027?
I think they're maybe stomaching the significant increase for next year. They heard that as well.
Yeah. Okay, there you go. That is the biggest thing we've been waiting for from Google.
We'll continue center operations costs such as energy. We also expect to continue hiring in key investment areas such as AI and cloud. And we are investing in marketing to support our AI products. And finally, we expect the free cash flow will remain under pressure, driven by our investments in technical infrastructure, which enables us to capitalize on the AI opportunity and continue to drive attractive returns.
Free cash flow remaining under pressure means they are guiding essentially for negative free cash flow for the next year. That's why I think you could be reading that. Yeah, it's bullish Nebius, bullish NVIDIA. All of those are up after hours. Technically bullish Google, but I guess, the market doesn't think it's that bullish. Wow, Nebius 230. All right, so the semis are liking it. Google is not.
Q2 represented another strong quarter. Our teams continue to deliver impressive innovation, executing with discipline and velocity. I want to take this opportunity to thank our employees for their contribution to our performance.
Philosophy and just constraints you're putting on the forward spend, how are those changing? You sort of think about the right amount to spend in 2027 to close this capacity constraint.
Look, thanks, Brian. I mean, it's a good question. I do think it feels like we are in very early innings of what feels like secular shift across multiple areas. in our core information businesses, just the possibilities when I see what all you can do with the absolute frontier capabilities. There's still a lot of work ahead to translate all that into experiences for our consumer users. You can think about end-to-end agentic experiences to really meaningfully do a lot more for them. So all of that looks like extraordinary opportunities with extraordinary returns for executing well on those opportunities. Similarly, on the enterprise side, as you can see from our demand, which is reflected in our growth rates, et cetera. Again, in my conversations with many CEOs, many companies, they're all still, barely scratching the early stages of what's possible here. So I think, we used to talk about cloud itself, very few, small percentage of overall workloads in enterprises have shifted to cloud. Now think about what percentage of workloads are really AI native and AI enabled. It again feels like very, very early. So I would say, from an ROIC standpoint, I think, we are taking a full stack approach. We are seeing momentum across consumers and enterprises and developers and so on. So it feels like, if anything, over the past year, we've gotten more bullish on the opportunities ahead. I'll turn it over to Anat.
Thanks for the question on how do we think about forward-looking CapEx in the context of supply constraints. So we're still in a supply constrained environment. I think we've said this now for multiple quarters in a row. And we are seeing very strong demand, both from external cloud customers as well as across the business. And our goal is to invest as long as we see an attractive return on that investment, as Sundar mentioned earlier. We do take a long-term view, so we take multi-year view at what the needs are, as well as focus on next year and the near term and building aggressively to meet those demands. And as you've seen, well, we have increased our capacity quite significantly over the past 3 years. The demand still outpaces that investment. And we are, just the rest of the industry, working in a supply-constrained environment. So we're working hard to do this. We do have a benefit of having the full stack approach. So we're able to drive operational efficiencies, technological efficiencies within our technical infrastructure organization so that we can deliver more compute. But as long as we see these attractive opportunities to invest, we will continue to invest.
Thank you both.
Our next question comes from Doug Anmuth with JP Morgan. Your line is now open.
Thanks for taking the questions. One for Sundar and one for Anat. Sundar, can you just talk about your confidence level that the Gemini models can remain at the frontier? I know you had the Flash model releases this week, but Google perhaps doesn't make maybe quite as much noise as some of the other leading labs, or perhaps have quite the frequency. Just curious how you'd address any concerns about that ability to continue developing leading models. And then just related, can you talk about your plans for coding and how you look to close the gap in that part of enterprise? And then Anat, just following the recent equity and debt raises, can you just help us understand how you think about optimal capital structure and how you view the cost of debt versus equity? Thanks.
Thanks, Doug. Look, I think the frontier is incredibly dynamic space, and it's fiercely moving forward. At any given moment when you take a snapshot, it feels dynamic. We've had clearly frontier models. There are many attributes on which we are still at the frontier. There are areas where we've acknowledged we need to improve. Coding and agentic coding is an example of that, and I think the teams are very, very focused on it. With 3.6 Flash, and by the way, Flash is our workhorse model, and we see tremendous demand for it, given it generally hits a sweet spot of performance, cost, reliability, latency, etc. And we've incorporated, Gemini and Flash, particularly in our entire portfolio of solutions, be it in cybersecurity, data analytics. If you think about an area like customer service, you need really good voice quality, you need live streaming, you need the ability to reason on that, or if you're a professional services firm, you need high quality summarization, content generation, etc. So, Flash does very well on all of that. In terms of agentic coding, we are iterating, and you will see us make continued iterations. 3.6 Flash, for example, compared to 3.5 Flash, jumped over, over 10 points in DeepSuite as a benchmark, and it is more token efficient doing so. So we are clearly, we are using it internally. We are testing it with many customers in coding. So we see the progress just in 6 weeks from the prior version to the new version, and you will see more continued iterations on that as well. In terms of the frontier, we are both very committed and very confident of being at the frontier. For the next generation of frontier, you're going to need much larger base models. We are now training Gemini 4, and we're being very ambitious with it. I am very excited by the progress I'm seeing internally on Gemini 4, and I'm confident the people will be pleased when we are putting it outside. But we will need Gemini 4 as a larger base model to compete at that frontier level, and so we are focused on executing on that well.
And on the question regarding our capital structure and recent equity and debt raise, so as we think about our investment needs, and as I said, we look at the next year and multiple years out, we first look at how much we can support based on cash from operations. And as you've seen in our results today, we continue to generate very healthy, strong cash flow from operations. So that's our first source of funding. And then we look at debt, and most recently we did the equity raise. And we have expanded our debt portfolio quite significantly over the past 12 months. If you've seen a year ago, we were at about $16 billion, and we went to about $100 billion across multiple currencies and geographies. So we're expanding that portfolio. But we also want to make sure we have a resilient, not just growth outlook, but also a resilient balance sheet and a strong balance sheet, healthy balance sheet, which is the rationale behind expanding into the equity markets. At this point, we're not planning to go back to the equity markets, with the exception of, as you recall, part of our equity offering was the ATM or at the market offering that we will do to address the stock-based or the tax on SBC, which we'll do for some period of time. But we look at those three dimensions: the cash flow from operations, debt levels, and equity, in a way to balance it in a way that ensures that we continue to maintain a healthy balance sheet.
Thank you both.
Our next question comes from Eric Sheridan with Goldman Sachs. Your line is now open.
Thanks so much for taking the questions. Maybe two, if I could, both on TPUs. Sundar, can you talk about some of your key learnings as you scale your TPU efforts in terms of both the demand for TPUs and how you think about balancing the external demands for TPUs versus the internal demand for custom silicon inside the organization as you look over the next couple of years? And then, Anat, if I could just follow up, you made some comments in your prepared remarks about the impact of TPUs on Google Cloud. I didn't know if you could give us a little bit more granularity about the size of TPUs as a part of the revenue backlog, and how to think about the revenue recognition or the potential for margin impact from TPUs in the years ahead. Thanks so much.
Okay, I think in terms of, first of all, we are very pleased with our TPU roadmap progress, and the value in terms of performance, and the edge it gives, and we obviously use it extensively. In terms of allocating TPUs, look, our first priority is making sure we are allocating what we need to compete at the frontier in terms of AGI development, and so that is the foundation for everything we do. But given the extraordinary demand, to balance the external demand, even for most cloud customers, we are using both TPUs and GPUs mainly for serving our models. So think Vertex AI, Gemini Enterprise, the momentum we see. So we're using it or agentic workloads, etc. So we are using it for those purposes. To the extent people want it as infrastructure, we are balancing it by increasingly looking at opportunities to put TPUs in their data centers or in other data centers, like the project we are doing with Blackstone, etc. So we're using that as an ability to balance and make sure we are allocating as much of the available compute for frontier model development, as well as serving both our consumer business and our enterprise business in terms of first-party models.
And in terms of revenue recognition and how we look at the TPU system sales, so the way to think about it is the following. When we sign the agreements that I've mentioned in the prepared remarks, they would be then reflected in the cloud backlog. Now, the vast majority of the $514 billion of cloud backlog is the GCP agreements, but the TPU system sales are reflected in that backlog. We start building inventory to be able to sell those systems. So you see that impact on the cash from operations because we built ahead, obviously, as we're building that business and ramping up. And then once we start delivering the sales, generally, that's when we start recognizing revenue. This quarter was a small amount of the total, that total agreement. Will continue to ramp up throughout 2026, but then you'll see the vast majority of the revenue from that agreements come through in 2027.
Your next question comes from Ross Sandler with Barclays. Your line is now open.
Yeah, just back to the AI model kind of war that's going on, Sundar. Just wanted to ask about like the speed of model releases and how you can potentially speed up the cadence by which Gemini is releasing models. So we all saw the third-party compute deal with SpaceX. What else are we doing to kind of speed up the pace of model releases compared to some of the other folks out there? And then you just mentioned the Flash models, which have been very successful, to your point. Do you view that as like the right end of the market to be in, given how crowded the lower cost end of the model space has become? Just any thoughts on how you see all that playing out?
Thanks, Ross. Look, I mean, two things I'll say. First of all, we really think about the Pareto frontier. We want to make sure for our customers, we are offering, best models at various price points, right? So, you will see us. But it's very important to us to have the best frontier models out there, as well as models which are very performant and low cost. This is why we have Flashlight, Flash, Pro, etc. And with so we are committed to being at the full Pareto frontier. On the speed of model releases, I do think you will see us continue to pick up pace. Obviously you've seen us come with we announced 3.5 Flash at I/O. We have followed that up with 3.6 Flash, and you'll see continued iterations of that model with further progress in agentic coding, etc. We are really focused, putting a lot of effort into Gemini 4. It's a very ambitious effort. We wanted to compete at the frontier level of where the frontier will be when Gemini 4 comes out. And so we are applying a lot of our compute and effort in that direction. But with that, we are creating a baseline on top of which you will see us rapidly iterate with subsequent model releases. And so, picking up pace and releasing models, almost at a monthly cadence is part of our roadmap as we are building Gemini 4 as well.
Your next question comes from Michael Nathanson with MoffettNathanson. Your line is now open.
Thanks. Thank you. One for Sundar and one for Anat. Sundar, just keep with the model theme of this call. Can you talk a bit about what do you think the moats are to this new model war? Right? What is your strategic advantages that fuel your business? That even if everyone gets to the same type of model capabilities, what gives you the edge to keep growing like you're doing? And then Anat, back to Eric's question, anything you tell about the margin impact on TPUs going forward, right? Is it incremental margin to the core cloud margin, or is it a lower margin from the group? Thanks.
Look, Michael, I mean, first of all, look, there are many layers at which we are providing solutions, right? I think part of what the value of our full stack approach is, customers are coming to us for solutions. So if you take an area like cybersecurity or data analytics, people are deploying solutions in which models are an ingredient in that solution, right? So take cyber, people are using Chronicle and Wiz, and with our upcoming CodeMender product, they're using it to detect and patch vulnerabilities and so on. Or take data analytics, people are bringing what's been in the past siloed data sources, putting it all together, and having an intelligence layer on top of it with Gemini Enterprise. And so the model is just an ingredient in those solutions. So I think it's important to remember that. Then even within where you're purely on a more model consumption area, people are, there is what looks as models are increasingly becoming end-to-end orchestrated systems, right? Workflows, agentic workflows. And to develop all this, it's your ability not just to bring the compute you need to train and serve, the data quality, the environments you have, your ability to continually improve, provide customers with that peace of mind that all the data they have, their data, their trajectories are confidential to them. None of that in any way flows back to the models. Their ability to configure and serve all this in a secure way and manage it and provision it and so on. So these are big end-to-end things. And so this is what our cloud business as a whole is focused on building it. And, when we are seeing demand across all of these components. And so obviously having our own models allows us to really optimize these solutions and bring an integrated offering. But we will also provide other models as part of these solutions. We also bring infrastructure as part of these solutions, et cetera, and take a whole full stack approach. So I think we are very, very well positioned there.
And on the TPU margins, we don't break out margins for any specific products or infrastructure component. And certainly there are benefits from designing and manufacturing our own chips. But the way to think about it is this is an expansion of our total addressable market. So it expands the opportunities by providing solutions to customers that need those systems in their data centers. But overall, if you think about the cloud margins, obviously a really fantastic expansion of margin to 35.6% this quarter, outstanding, strong operational discipline across the business and leveraging growth in the top line. And now as you think about Q3 and through the remainder of the year, and I've mentioned some of it in the prepared remarks, given the supply constraint environment we're in, we are planning to expand the use of third-party capacity in Q3 as a bridging strategy while we continue to build out internal capacity. That capacity, given the cost of that capacity, will put some pressure on operating margins for cloud. And then the last item we mentioned in the past was the integration of Wiz does create some headwind here in the near term in 2026 related to the acquisition.
Thanks, guys.
Your next question comes from Mark Shmulik with Bernstein. Your line is now open.
Yes, thanks for taking the questions. Anat, just on these third-party deals and kind of the bridge and capacity, is there a particular objective where the constraints are most severe, or is it really broad-based? And I guess, stepping back a bit and thinking about capacity allocation across the businesses, has that changed at all, or is there a way to contextualize how you're now thinking about the trade-off between allocating compute to search versus model training versus for the GCP business? Thank you.
Mark, I can comment on it. Look, again, on allocation, I think, the baseline with which we start is what it takes to, continue AGI development at the frontier. Obviously, the priors on that are just based on where the model frontier moves. And so we start with that as a baseline. And beyond that, we want to obviously, we are prioritizing our core product areas like search, YouTube, etc., as well as cloud. And within cloud, we are prioritizing the compute to make sure we can serve our models, in the context of Vertex and Gemini Enterprise and our core solutions, be it data analytics and cybersecurity, et cetera, right? So our core serving for our core products across consumers and enterprises where the compute is primarily going, and that's how we think about it. I think on the bridge deal, the main thing I would say is, look, there are on the margin, there are very, very large customers of ours on cloud who we are trying to support them through this extraordinary moment, and the incremental opportunities they are bringing to us, while a short-term cost over a few months may be very high, in the lifetime of the deal, as we bring more capacity on, is highly ROI positive, right? So those are factors we are taking into account. So are you willing to take upfront 6-month deal to be able to serve that customer in what is a multi-year opportunity where the margins and the returns are very, very attractive over that multi-year horizon? So hopefully that gives some color on how we thought about those opportunities.
Your next question comes from Ron Josey with Citi. Your line is now open.
Great, thanks for taking the question. Maybe I'll switch topics somewhat and Philip, ask you a little bit more about monetization from a search and YouTube perspective. Just given the greater signal we have with AI searches, and then you talked about YouTube strength. Talk to us a little bit more on how advertisers are leveraging the greater personalization and targeting that Google has to drive this ROAS. And a question we often get is, Google is at size and scale, we're still growing 17%. Any reasons what's driving that all-time high on searches? Thank you.
Yes, thank you so much for the question. Look, our 17% year-over-year growth rate in the Q2 search and other revenues was really driven by many parts of our business working well together and very, very deep Gemini integration. Maybe to zoom out for a second, all the major verticals contributed to the growth. Retail drove the greatest contribution. I managed this, followed by really meaningful contributions from finance, tech, media, entertainment, and so on. I think it's really important to understand that Gemini supercharges our ability, and this goes specifically to your question, to understand what people are looking for and match the right ads. So we're applying Gemini models really across our entire ads infrastructure, whether it's ads quality, advertising tools, ads and new AI experiences. And we're really deeply integrating Gemini into the customer tools to make the campaigns more efficient, which comes on top of this. And then we have our AI-powered campaigns like AI Max that help advertisers actually adapt and find the opportunities beyond keyword. Again, that's an ability for us to go deeper and target better. And AI Max continues to unlock, we mentioned this, billions of net new searches that weren't really monetizable before. And then on the YouTube side, high level, the ads growth was driven by direct response and brand advertising. I shared earlier, we continue to see a lot of momentum in the living room. We have a really exciting ads roadmap as well ahead of us on the brand side, on the direct response side. Demand gen and shorts remain really interesting opportunities here. Again, this has targeting components to it, obviously. And we continue to innovate really heavily in direct response with shoppable ad formats in the living room, which will help us drive strength in retail as well.
Your next question comes from Ken Gawrelski with Wells Fargo. Your line is now open.
Thank you very much. 2 questions, please. First, how would you assess the forecasted returns on compute capacity investments in 27 compared to prior years, 25 and 26, in light of the supply chain constraints and supply chain inflation we're seeing? I'm curious as to how you think about the return profile of 27 and kind of future investments versus past investments in capacity. And the second one, a little different topic here. When you think about Waymo, what are the key factors you would consider when evaluating a change in corporate structure for Waymo? I know you've previously been reticent to talk about this, but the business is scaling. Clearly, there's leadership there. and has a lot of momentum. Under what conditions would it make sense for Waymo to live outside of Alphabet? Thank you.
Look, Ken, on your first question, if I understand it, we are working off a discipline ROIC framework here. Obviously, we, to the extent that our input costs going up to us, we reflect that, in our ability to, price our solutions and see returns there. So all of that is factored into how we are planning. I think our compute capacity investments in 27, I think to the first question I answered, I think we are, we are seeing strong demand indicators, including long-term deals, the existing deals which we have, which are renewing at with exceptional demand on a moving forward basis. And so we are using all that to plan and invest accordingly. And so, I think if anything, the dynamics look healthier than where we were about a year ago. And so that's what gives us the confidence to undertake those investments. On Waymo, look, I think we are really focused on executing and scaling up Waymo. We have set it up with our bet structure and given the team a lot of support. Alphabet has continued. I think our ability to think and plan long term and invest in the business is and give them that long-term roadmap, the confidence in undertaking a long-term roadmap and scaling up, I think is all hugely valuable. We're really focused on scaling the business right now and executing to that extraordinary potential, and that's what we are focused on.
Thank you very much.
Our last question comes from Shreya Kajuria with Wolfe Research. Your line is now open.
Okay, thanks a lot for taking my questions. Could I please ask you two? One is on TPU long-term strategy. Longer term, is it fair to think that as TPU sales scale, you'd build merchant silicon business with a software stack that goes with it? And second is on YouTube revenue. Given how strong engagement is, what are some of the factors that could drive accelerating growth rate at YouTube on a go-forward basis? Thank you.
Maybe I'll answer the first one, and Philip can broadly talk about YouTube revenue growth as well. On the first one, on TPUs, look, I think we've been operating with TPUs for a while. A lot of our cloud serving is done on TPUs, and we are also seeing strong demand for TPUs as standalone systems from other customers. And so obviously the industry has constraints too. So we have to plan and we allocate on a forward-looking basis along the principles I spoke about earlier. So I don't want to project out too far into the future there, but I do think we are, obviously we will scale up based on the opportunities we see and the demand we see, commensurate with the constraints that exist and the allocation needs we have for frontier model development, making sure we can serve our consumer businesses and enterprise businesses well. And Philip, you want to add on YouTube monetization?
Yes, thank you so much. So look, I mentioned it, the drivers of YouTube ads revenue growth. I think there's a lot of things we're actually excited about when we look at our ads roadmap here. In brand, we see ongoing opportunities on connected TVs in the living room. We're building tools to help advertisers find creators, scale across screens, and then measure the results. And we have a slate of new and returning creator shows that are coming exclusively to YouTube. We see opportunities in direct response, particularly with demand gen, and Shorts. I mentioned it remain a really interesting opportunity here to expand our base to more small and medium advertisers across more verticals, shorter videos, actually, this important one, create more opportunities for less disruptive ads, increasing the overall ad effectiveness. So we're going to continue to see a lot of innovation, in my opinion, in direct response with shoppable ad formats in the living room, which, again, we mentioned that drives retail strength. We announced a few other formats here at Brandcast. We announced Buy with Google Pay to enable CTV viewers to actually complete purchases directly on their TV with 2 clicks, which is a really interesting opportunity over time. We launched the Affiliate Partnership Boost to drive incremental sales and the creator earnings, obviously, from YouTube Shopping affiliate commissions. So overall, frankly, very, very exciting times.
Thanks, Sundar. Thanks, Philip.
Thank you.
Okay, that's Google. We move on to Tesla. We will analyze all of it after the call.
And is setting records across the board. So its popularity is increasing tremendously. And we're seeing in locations that have FSD approved, we're seeing a very high take rate of FSD. And in fact, I think for a lot of people, they're actually buying Tesla Full Self-Driving with a car attached, as opposed to a car with FSD. They're coming into our stores in the US and saying they want the Full Self-Driving and with whatever car it comes with, essentially. So clearly, this is a significant demand driver, and as we get approval for FSD in different countries, I think we'll see a similar uptick in demand. Yeah, it's looking very good on that front. The energy business is also growing incredibly fast, and I think will be crucial for the scale up of artificial intelligence data centers. We're investing a lot in growing the core business and really preparing for the future. So this is a massive CapEx year, but I'm confident that all the things that we're investing in will yield incredible returns. Really, maybe the best CapEx returns that we've ever seen. And just the Tesla team has performed incredibly well. The Cybercab has started production, and we also have started production and are ramping in. We will soon start production with Optimus. We have started production with the Tesla semi-truck. We will soon start production with Megapack 3. We've started production with the lithium refinery, the cathode refinery. We're scaling up battery cell production, and we're also preparing to do a massive solar panel, like solar cells and panel production. Actually, this is going all the way from silicon refinement to producing the solar cell and then deployment of solar, because there's going to be tremendous need for electricity in the future due to electrification of transport and AI, obviously. So we're working on what we believe is the most ambitious build-out of advanced infrastructure and manufacturing capacity ever in history. It's a big deal. So with Robotaxi, our goals are very ambitious for Robotaxi, but we do need to be cautious about causing any accidents or causing any harm to anyone. Although there are, I think, 30 to 40,000 automotive deaths per year in the United States alone, most of those do not generate any press on it. You never really read about almost any of those. But if we injure even one person, it will be worldwide headline news, and regulators will immediately clamp down on our activities. And we don't want to injure anyone. So we're going as fast as humanly possible in scaling Robotaxi, but while trying to ensure that we do not harm anyone at all, and ideally do not even run over a pet. So that's really the constraint. Is we want to grow as fast as possible with Robotaxi without harm to anyone. And we're providing live updates for Robotaxi launch as we open up in a city. We immediately post that on X. So if you just follow the Tesla account on X, we'll keep you informed as we scale to new cities. We've opened up in a number of cities in Florida and in Texas, and obviously in the Bay Area. So we'll continue to scale, I think, very very rapidly with it looks like more than 10% a week in terms of miles driven. So it's a very high compound growth rate. So let's see, Optimus. As you've heard me say before, I think Optimus will be the biggest product ever, but it is a very complex problem to solve. It's one of the hardest things to solve, to make an autonomous humanoid robot that can do tasks that if you simply ask it to do something or show it a video, it can do the task without any programming. Like no one's ever achieved this. And there are many challenges in the electromechanical design of the robot to achieve sufficient dexterity and also be very reliable and have long wear and tear. Like meaning it needs to be out in the field and not break down. Otherwise, you've got sort of a 70-kilogram robot that just flopped over, and you've got to carry it out like a body. It doesn't have wheels. So and we don't want Optimus to go haywire. It's a lot of work to scale to get the design right and to scale production. And I really want to emphasize here that the production scaling challenge is very substantial. This is going to be the hardest product to scale manufacturing that we've ever made at Tesla, because everything on the robot is new, and the difficulty of scaling the production ramp is proportionate to the newness of the parts in the robot. And at least with electric cars, the non-electric powertrain portions of the cars had an existing supply chain. So you could go to existing suppliers for wheels and side mirrors and windshield glass and that kind of thing, body panels. But with Optimus, there is no supply chain. So we've had to build up a supply chain in its entirety, or in-house the production, and we've in-housed a tremendous amount. The Optimus production line that we're building out in Fremont, in place of what used to be the Model SX production, it looks incredible. I mean, it's quite stunning to see. So I just want to make sure to calibrate people correctly. Optimus will follow the sort of normal S curve of manufacturing of a manufacturing ramp, but the initial portion of the X curve will be quite flat and long because of the newness of the parts in the robot. Now you've probably seen lots of impressive demonstrations of robots on the internet, but those demonstrations you're seeing are pre-programmed or remote controlled. So there is no humanoid robot that is actually able to do generalized tasks. Optimus will be the first one that is capable of doing that, where it's not just a demo; it's genuinely useful in day-to-day life. So, and Optimus is designed to have full human dexterity, so a hand that has the same level of dexterity, if not higher, than a human hand. And the human hand is an incredible thing. The more you study the human hand, the more amazing you realize how amazing hands are. It's more than just opposable thumbs. I mean, the nuances of how human hands work are amazing. As the closer you look, the more amazed you are. And Optimus will have that capability. You'll have human and then superhuman dexterity. So it's really going to be quite something. Let's see, Terafab. The Terafab, we expect to announce the location soon, and provide more details about our plans in that regard, which we'll leave that to the product, sort of the launch announcement, rather than try to squeeze it into an earnings call, because I think this is a very big announcement, and it deserves to have its own sort of stay in the spotlight and not be sort of squeezed into an earnings call. But I do think Terafab is going to be an amazing initiative and a necessary one, and one without which we will be constrained in our ability to scale Optimus production, because we simply won't have enough AI chips. So it's crucial to solve that, and we'll have to solve memory, logic, and packaging in order to scale Optimus. But anyway, like I said, we'll leave that to its own announcement. We've placed equipment orders for our development fab in Austin, and that development fab, I think, is pretty cool because it's intended to have lithography mask production, and then logic, memory, and packaging and chip testing all under one roof. So you can have a very fast iterative cycle, and try out new chip designs very quickly and see if they work. I don't think such a building exists anywhere on Earth. So this is really going to be super helpful as we try some exciting, adventurous, high risk, high payoff bets on AI chips. But it's focused, like I said, primarily on Optimus. Like, how do we make Optimus as useful as possible? Then we have Digital Optimus, which is basically just driving a computer screen. I guess you could call it computer use or something like that. But driving a computer screen in the same way that you drive a car. So for the car, it's sort of pixels in or photons in and controls out. The same thing is true for Optimus and Digital Optimus. It's photons in, controls out. So we feel confident we can adapt the same Tesla AI technology that we developed for self-driving cars to have a self-driving computer screen, or self-driving computer, essentially. So the self-driving computer, where the Tesla, the very, very low cost Tesla AI4 computer can handle all of the sort of short-term tasks. They're doing real-time video control of the screen of the computer. So it's not like screenshots type of thing. It's real-time video at high frame rate. And Digital Optimus will be important, obviously, for Physical Optimus, because Physical Optimus needs to be able to operate computers. It can't come up to a touchscreen and not know what to do. It's got to have a generalized touchscreen and computer use capability. So that's looking promising. Then this is in partnership with SpaceX's Grok, sort of the big model that is kind of like the manager of Digital Optimus, and kind of tells Digital Optimus what to do, provides it with a series of tasks, and then Digital Optimus goes and does those tasks. We're also building out a Megapod design that has Tesla AI4 computers with x86. It's a pairing an x86 computer with the Tesla AI4 computer in a box. And it's kind of just Digital Optimus in a box. And in a Megapod, kind of like the Megapack packaging. And so where we put just a large number of AI4 plus x86 combos in a giant box, essentially. And that these boxes can be placed anywhere in the country or outside the country. And this allows us to scale AI compute using disaggregated electricity production. So because there's lots of places all around the world, including at our superchargers. I think we've got something like 7 gigawatts of power at our superchargers and growing. And we can place megapods at many of these superchargers and have distributed power for AI. So I think that could be quite a big deal. So in conclusion, we're super excited about our autonomy and robotics roadmap. There's so much awesome stuff coming. It's like I said, hard to squeeze into an earnings call. But we'll have a lot of product announcements. And this is going to be a great year for Tesla. I think one of our best years ever. And then I think next year will be even better. So in conclusion, I want to thank the Tesla team for their excellent execution and all of our supporters for joining us in this journey. Thank you.
Great. Thanks so much, Elon. And now Vaibhav has some opening remarks.
Thanks, Travis. So Q2 continued the trend that we saw at the end of Q1, a resurgence in demand for vehicles across the globe. We achieved record Q2 deliveries globally with sequential growth across the Americas, APAC, and EMEA of 60%, 27%, and 12% respectively. Additionally, Model Y set records in several key markets, including the Netherlands, Australia, and New Zealand. The efforts of the Tesla team to create compelling products at a reasonable price with the capability of autonomous driving are coming to fruition. We exited Q2 with our largest order backlog since 2023. We are therefore focused on increasing production at all our factories to meet this growing demand. Production growth will be limited by our supply chain. This includes not just batteries, but also electronic components. We've been here before, and like always, our Tesla team is working actively to unblock the obstacles ahead by securing strategic deals with suppliers. Like Elon mentioned, one of the key factors for vehicle demand has been FSD. Our sales data suggests one of the main reasons customers are coming and looking at the car is because of FSD. In Q2, we had in North America, about 55% of our deliveries had FSD subscription at the time of delivery enabled. Overall, FSD attach rates continue to improve, reaching nearly 1.5 million paid customers globally, of which 55% is upfront purchases and the remaining 45% is subscriptions. We expect that the bulk of the growth in FSD monetization will come from subscriptions as we've removed the purchase option in most markets. Automotive margins, excluding regulatory credits, declined sequentially from 19.2% to 16.3%. As a reminder, we had highlighted in Q1 that we had a $230 million benefit from warranty true-downs and some tariff relief, which did not repeat in Q2. Controlling for the impact of those benefits from the prior quarter, our automotive gross margins, excluding credits, would have been approximately flat. This demonstrates the effective pricing and cost management done by the Tesla team as we continue to drive demand. Commodity price increases and interest rate changes all continue to add to our costs. Note that interest rate subvention costs are recognized upfront as revenue offset. So as interest rates have risen this year, the cost of subvention has risen along with them, which had a negative impact on automotive margins. As we have previously noted, energy business is inherently lumpy. Deployments are tied to customer timelines and largely out of our control. In Q2, we deployed 13.5 gigawatt-hour of energy storage, a 53% sequential increase, and the second largest quarter for energy business. Despite this growth, energy gross margins declined from 39.5% to 20.4%. This margin decline was a result of several dynamics. First, there was a warranty true-up in the quarter of about $240 million related to certain vendor cell issues for our legacy deployments. Also, the tariff benefits we recognized in Q1 of more than $200 million did not repeat. And lastly, we had previously guided that ASPs for industrial storage is coming down amidst growing competition. Long term, we believe the energy business should normalize at a gross margin rate in the mid to low 20% range. Our order backlog of this business is robust and we are doing our best to build based on both existing demand and future demand we expect from data center growth and overall electrification of the economy. Service and other margins improved sequentially from 9.2% to 14.1%, an all-time high. This was mainly driven by an uptick in volume and better cost management of our vehicle fleet that supports businesses such as used car, supercharging, service centers, and insurance. While marginal today, also included in this business are deliberate investments we are making in infrastructure that will help scale robotaxi in the future. We continue to grow the Tesla robotaxi fleet and have expanded to a total of 7 markets in the US. We expect the ramp of the fleet to accelerate throughout the year, along with expansion into new US markets. As previously guided, operating expenses increased sequentially. The increase came primarily from significant research and development related activities, including pre-production ramp costs for new products like the semi-truck, Optimus, Cybercab, and other AI initiatives, as well as depreciation for an additional compute that we brought online. Additionally, we had charges related to litigation expenses in the quarter. Note that we are in a big investment cycle and expect our operating expenses, largely driven by R&D, to continue to grow in 2026 and beyond. Net income was positively impacted by a mark-to-market gain of $1 billion on our SpaceX holdings, which was offset by losses on FX of approximately $300 million and on Bitcoin of about $100 million. As previously guided, our free cash flow ended up being negative for the quarter. Most of the reason for it going negative is because CapEx more than doubled sequentially, and we expect it to increase further in the second half of 2026. We continue to expect that CapEx for this year will be more than $25 billion. CapEx will grow for the next 2 or 3 years as we expand our robotaxi fleet, expand our production capacity for Optimus, make investments for semiconductor fab, install solar manufacturing capacity, and AI compute infrastructure, in addition to all the other expansions we'll do for other manufacturing for automotive. In addition to using our cash for such investments, we are being opportunistic in securing certain debt facilities that will give us the capacity to borrow up to $30 billion to help accelerate such investments. We believe this is the right strategy to position the company for the next era, and we'll always make such investments in a very capital efficient manner. The path to amazing abundance is ever challenging and requires making bold bets. Our progress will be non-linear. The future is going to be great, and we are ready to rise to the occasion. I would like to end by thanking the Tesla team, our customers, investors, and suppliers for their confidence in us on this journey.
Thanks so much, Vaibhav. As everyone on the call may have noticed, we've covered several of the Say.com questions already in opening remarks, including Optimus production, Terafab, and Digital Optimus. Ashok is joining us today, our VP of AI, and he's going to cover questions related to robotaxi. Ashok?
Thank you, Travis. Many of the questions on Say.com relate to robotaxi deployment and scaling, so we thought we'd provide a comprehensive view of where we are now and where we are going in the future. First of all, I'd like to state that the robotaxi program has been operating extremely well. Especially in terms of safety, the program has had an impeccable safety record. We have driven more than 380,000 miles of unsupervised robotaxi, now across 6 cities in 2 different states. We have had 0 notable incidents. Any reports have been of other actors impacting us when we were stationary. Again, I like to emphasize how safe the operation has been so far. 0 notable incidents over 380,000 miles. Historically, the so-called experts have always claimed that you need LiDARs, radars, HD maps, and the entire kitchen sink to drive safely. Here we show that such is not true. You can have safe, comfortable, and affordable autonomy with just cameras. This record should be a huge validation of Tesla's entire AI approach. Second, I'd like to discuss scaling. We started the robotaxi program roughly a year ago in Austin. We had safety monitors in the passenger seats of the cars back then. Around the end of last year, we had the first fully unsupervised robotaxis in Austin. Since the beginning of this year, we have grown at double-digit growth rates to the number of unsupervised miles that the fleet drives every week. I repeat, we have grown at such a high compounding rate on a week-over-week basis over the last several months. Not only that, we expect to continue growing at such a large rate through the rest of this year. The other thing to note is that for expanding to new cities, it has been relatively less effort on our front. We expect that the time to launch to a new city will continue to trend towards zero, towards an end where we operate in entire states as a whole instead of going by city by city. Such growth was only possible because we have a world-class engineering team at the frontier AI development here at Tesla. The currently operating robotaxi fleet is already running early versions of the V15 FSD software that we had referred to in the past. For V15, we had planned roughly about 7 major improvement tracks, and they're all happening in parallel. The early V15 builds that are running on robotaxi have already 40% of those tracks merged together, and that's what's running in the fleet right now. As we continue to complete our work on V15, we will see that the car is going to be ridiculously safe and capable. We're already seeing internal signs that all of these bets that we have made for technology improvements are all continuing to starting to work, and we expect that the payoff will be huge, and that's what is going to help us sustain the same growth rate through the rest of this year and so on. Finally, regarding the Cybercab, first of all, it's a phenomenal product. Anyone who rides in it instantly falls in love with the experience. We have aligned our manufacturing targets to roughly match the projected growth rate of the unsupervised miles. The same V15 models that power the Model Y and other platforms will also work on Cybercabs. In conclusion, robotaxi growth so far has been literally exponential while keeping an impeccable safety record. Our technology bets are paying off, helping us sustain the exponential growth for the foreseeable future, and the Cybercab is going to be awesome.
That's great. Thanks so much, Ashok. And there was one remaining question on data collection for Optimus training. Would you mind covering that as well?
Yep, definitely. Regarding Optimus, especially Gen 3, Optimus has been designed to not just match the appearance of human beings, but also the functionality and dexterity of humans. One of the main reasons for this approach is that having the human form factor and function allows us to learn from humans on how to perform a wide variety of tasks. This opens up the entire world to provide data for training Optimus. Just like FSD, we have access to a broad fleet of humans giving us data from all of the workers at our factory. Optimus can learn quite a bit from observing them perform their tasks at the factories. We also have a dedicated data collection team who can provide a relatively small amount, but of very high quality demonstrations to do the post-training of these models. This is all on top of any training we can do off of the entire internet of data that shows demonstrations of people doing various tasks, both in industrial settings and home settings. The second flywheel is when we have a large number of Optimus robots practicing their tasks in what we call the Optimus Academy. The data from the bots experiencing the tasks themselves will be invaluable and help us close any minor form factor gaps that may exist between the bot and the humans. This is also when the reinforcement learning loop kicks in, where the bot initially attempts some tasks, fails sometimes, learns from both the successes and failures of those tasks, and eventually learns to master those tasks at perhaps a superhuman level. Our AI strategy for Optimus is aligned with the same. It's the same end-to-end strategy that drives FSD, pixels in, controls out. And just like FSD, we expect it to work broadly. In FSD, you can get in the car, type in an address, and then hit start, and it's like handles all of driving from park to park. And the same thing is going to be true for Optimus as well. You're going to just ask it to do anything, and then it should just perform the entire task on its own without you having to do anything along the way. And it's the same team that produced the FSD, the V12, 13, 14, and now V15 software that now works on Optimus as well. Hence, I'm very confident that Optimus will be an extremely capable robot.
Great. Thank you so much, Ashok. So that covers the say.com questions. Now we will move over to analyst questions. The first question comes from Tom from RBC. Tom, please feel free to unmute yourself when you're ready. Tom, you're still on mute, so please unmute yourself and go ahead and ask your question. All right, we're not getting any audio from Tom at the moment, so we
a lot of that yourself. I'm just curious, as you've gone through this exercise, are you seeing any suppliers willing to invest alongside you to set up domestic manufacturing to potentially help you scale more quickly in the U.S.? Asking that in the context of obviously you want to control your own destiny to some extent and ramp as quickly as possible, but from an investment cycle standpoint, potentially more capital efficient to have some partners, help you along the way. So I'm just curious how you're thinking about that and some of the dialogue you've had with potentially some external suppliers.
Elon, you may be on mute right now. We can't hear you.
So yeah, our suppliers have been great, and they have made and are making tremendous investments in support of Optimus and Robotaxi and whatnot. Samsung and TSMC in particular are building fabs. TSMC in Arizona and Samsung in Texas, and putting in tens of billions of dollars to build AI compute for Optimus and Robotaxi. Panasonic has also invested many billions in increasing battery cell production. Probably I'm a little under the weather here. I'm a bit ill, so if I sound a little off, I'm kind of struggling with I'm a little bit ill today. So yeah, but our partners have been great, and I'd like to thank them for their support and their investment and their hard work.
Great, thanks for that. And maybe just as a
So, sorry, Andrew, we're going to have Karn hop in here for additional color briefly.
Yeah, just to add to Elon's point, that the Samsung fab that's going to be pretty significantly dedicated to future projects. That's a massive investment, multi-billion-dollar. We're seeing the same level of investment going to memory, and also new specific parts like metal injection molded parts, flexible printed circuits, and all sorts of novel new technologies that are more based for the robot as opposed to the traditional vehicle supply chain we've had. And in certain cases where we don't find a great partner, we've never hesitated from insourcing it. And we have a very capable manufacturing engineering team and a design team that helps us scale those things.
Yeah, and actually, I'd also like to thank Micron for giving us memory allocation. They're going to make some very tough decisions on memory allocation, and we really appreciate Micron making room for Tesla in the years to come, and giving us actually a very significant allocation on reasonable terms, given the pretty insane pricing of memory these days.
Great, really appreciate that color. And maybe just my follow-up on robotaxis. You guys gave a lot of great information in your prepared remarks, but there seems to be some evolving regulations at the state level, potentially around sensor requirements. So I'm just curious, as you think about your own rollout, what do you want to see, or what do you need to see from regulators to make sure that, obviously some regulation might be good, but you don't want it to be over-regulated. So what are you expecting to see? What do you want to see to make sure that this is, done in a proper way?
And we've got Lars on the line. Lars, if you wouldn't mind covering this one, if you can.
Yeah, sure, Travis. I think, when we talk about regulation, particularly in the U.S., we've made a lot of headway. Just good initiatives from the federal government in terms of the FMVSS rules, moving towards, acceptance and adoption of purely built AVs, and I really appreciate the support from NHTSA on that. When it comes to like a state-to-state level, obviously the stuff in New Jersey, is a little bit disheartening. I think ultimately, as Ashok said in his opening remarks, we really focus on the performance of the vehicle, and ultimately that's what's going to drive regulators and the public to adopt it. I think the best regulations are those that provide companies and innovators with a goal or a task and allow us to figure out the solution. And when we see regulations that provide a solution before identifying the problem, we really don't, appreciate those. But as Tesla always has and will continue to do, we'll let our performance speak for itself. And I think Ashok played that out really clearly, and that'll be the foundation of our expansion moving forward.
Great. Thanks for the questions.
Thanks so much. We're going to try Tom again from RBC. Tom, can you unmute and try to speak, please? Unfortunately, Tom, we see you unmuted, but we're not hearing you. So we're going to have to send you back into the queue. Next is Alex from Bank of America. Alex, as soon as you can, please unmute yourself.
Hey, thanks for the questions here. Just a few follow-ups on Robotaxi, actually. I guess what milestones should investors be watching from here that would cause you to accelerate your fleet scaling or market deployments? Is it the further safety validation, like a miles driven per incident or something else? And then would you ever consider third-party distribution partnerships, such as with rideshare providers, to increase utilization? Or is the plan for now to keep Robotaxi fully vertically integrated? Thanks.
Yeah, we expect to be vertically integrated with Robotaxi as we are in the rest of our business. So I don't think we're going to have any demand challenges with Robotaxi. So this is the economics will be so compelling that I think we will really have a lot more desire to use the service than I think demand will outstrip our ability to service the demand. And so obviously there's no you can just go vertical in that situation. So it's really just about going through and what we call the march of nines of reliability, where you need like how many nines of reliability do you need to scale? Ideally you want 99.99999% reliable. And so it's just the march of nines of reliability is I think the only thing really constraining our growth in Robotaxi.
Great. Thanks, Elon. The next question is going to come from Colin at Wells Fargo. Colin, please unmute yourself when you're ready.
Oh, great. Thanks for taking my questions. There's been a lot of chatter about SpaceX and Tesla combining in some way. A lot of collaboration already today. Elon, do you see synergies eventually from combining the companies? Does that make sense from your perspective over time?
Well, as you can tell from all the many collaborations on so many fronts with SpaceX, and there's more and more overlap, especially with Terafab. That's really going to be a gigantic project. But obviously we can't talk about combining companies and that kind of thing on an earnings call. It's got to be done with the appropriate process. And with that, I'll turn it over to Brandon, our General Counsel.
Yeah, thanks, Elon. And that's exactly right. We continue to benefit from our relationship with SpaceX, and they've been a great partner, and we have numerous beneficial transactions with them. And earlier this year, we deepened our relationship through an investment and a framework agreement. And this will allow us to continue to work with them on projects that Elon mentioned, like Terafab and Digital Optimus.
Yeah, and there's many other things too. Obviously, you've got Grok in the car, and Grok helping drive Digital Optimus. You've also got Starlink being integrated into the Cybercab, and Sonic will be integrated into for long power vehicles, at least for markets that Starlink is active. Because for a robotaxi situation, you need to have coverage everywhere. And there are many places, even in Silicon Valley, where the cellular coverage is a terrible or sometimes non-existent, which is surprising for Silicon Valley. But I know when I drive to work, those first 10-15 minutes, I can't actually do any calls because the cellular connectivity is so bad. So we can't have robotaxis getting stuck in these like Bermuda triangles of lack of cellular connectivity. So Starlink, with its ability to do connectivity anywhere, is actually quite important. So we don't have robotaxis missing in action. And then obviously if people are sitting in the car, they're going to want to do high productivity stuff or what entertainment. And with Starlink, you can watch 4K live sports in the car, and with very low cost per gigabyte of data. As that's really not feasible via the cellular system. And there's many other situations.
Yeah, I mean, I would say think of it like Ashok was mentioning about CyberCab, right? That the experience is great. In a world when you don't have to focus on driving, you have all the time in the car to do, whether it's a conference call, watch a movie or anything. That's why if you look at the CyberCab design, it has a big screen. And we've started doing CyberCab rides in our factory in Austin. And when you go through that experience, soon customers would be able to do it in not too distant future. And then you'll understand why that connectivity becomes so important.
Great. And then Colin, do you have a follow-up?
Yeah, just if I would follow up on robotaxi, if I look at the launches, you've been adding cities, but the number of units is still, looks like based on media reports, sort of in the dozens as opposed to hundreds. Why not just sort of scale up Austin or one or two cities before adding cities, and sort of what do you need to sort of get that higher volume numbers in a major city? What sort of is the roadblock to sort of adding more vehicles on the ground?
Yeah, the reason we have been expanding across different cities instead of just doubling down on a single city is that we want to make sure that our stack is a very general one. It is a general one. We just want to both prove to ourselves and to other folks that it is working across a lot of different cities without too much effort per city. And that's what we see internally. And then, as Elon mentioned earlier, the growth rate has been literally exponential. Just it's in the early part of the exponential. That's why it's hard for others to comprehend. In terms of like miles versus the vehicles, since these vehicles operating the robotaxi fleet drive basically continuously, as opposed to human drivers who use vehicles for maybe a couple hours a day or something like that, these vehicles are in mostly continuous operation, which means that even for a few vehicles, you can get a lot of miles out of them. And that's why we are tracking the amount of unsupervised miles or just the number of vehicles or something like that. And we want to be operating in a very efficient fleet. So all of the work that goes into the efficiency makes it even more so that we get a lot of miles per vehicle available in the fleet.
Yeah, and just to add further to this, think of it, we're trying to scale this, and we're trying to make sure that there are different kinks which would be there. And there are things not just on the software front, on the operation front, which we're also trying to tackle. So that's why we're trying to have a broader footprint to try and make sure before we go really high in terms of deployment, that we are able to sort these things out in a smaller fleet in a controlled manner.
Yeah, one of the things for CyberCab should be noted is because it is a new vehicle chassis, we need to accumulate driving data that is specific to the CyberCab before we can put a lot of them on the road. So unlike say Model 3 and Model Y and our other vehicles, where we've got a lot of vehicles on the road, millions of vehicles on the road, we don't have that for CyberCab, so we actually have to accumulate miles with CyberCabs that are retrofitted with steering wheels and brakes, acceleration, braking pedals, that kind of thing, to calibrate to the CyberCab chassis. So you'll see as we are confident about that, the number of cyber cabs in cities will increase dramatically.
Great. Our next question is from. Oh, yeah. Go ahead, Lars.
If I can just add like one thought here. The other reason I just want to like point out is, you know, TCO, transportation regulatory situations are different city by city, state by state. It is not a federal, you know, framework to do that. And so like the reason we're expanding city by city is to make sure that we're meeting all of those one at a time, and we're satisfying, you know, all of the requests of each individual city and you know, in every way we can. And so we have to expand, you know, to each city to meet those requirements, and we'll continue to do so. And until all of what Ashok and Vaibhav and Ashok said, we'll follow with the scaling.
Thanks, Lars. The next question is coming from Walt from Lightshed. Walt, please unmute yourself.
Thanks. It's just a quick follow-up for that Lars comment. I mean, the NHTSA administrator, Jonathan Morrison, was just on CNBC. You know, he already, you know, was trying to get rid of the pedal and said, I forget his exact term, but it seemed like he wanted to get rid of the steering wheel. It seemed like that would be a gating factor. But is there other things that you need at the federal level to really kind of unlock your ability to ramp CyberCab?
I mean, the short answer is no. I mean, I think we have a great relationship with NHTSA and you know, Director Administrator Morrison especially. And you know, I think they're just following through with what you know, the public wants and the world knows is coming, and they're trying to stay ahead of it and make sure that, you know, they're doing the right things in place. So you know, we've been open and honest with them for the last couple of years about what our plans were and what we're doing. And yeah, I don't want to say we're in lockstep, but you know, I feel like we have a partner there, and we're working together on it.
Got it. And then just, Elon, it's kind of a roadmap question, I guess. Starlink obviously is integrated in CyberCab, and you guys just talked about the connectivity for watching movies, but what about the flip side of that? Can the CyberCabs become remote hotspots for Starlink Mobile? And then similarly, roadmap question on the Semi, you know, when do you anticipate looking at autonomy for the Semi? Because that seems like a pretty sizable market as well in terms of autonomous trucking and the need for it, given what's going on in our country right now.
Yeah, absolutely. There, as you allude to, there is a really serious shortage of truckers. So there just aren't enough people who want to drive trucks, which are crucial for transport throughout America. So an autonomous Semi is actually going to be very important to address the shortage of truck drivers. And obviously will be great for improving safety and you know, making it easier on truck drivers to have a self-driving Semi is going to, yeah, I think dramatically improve safety and comfort for truck drivers that you know, yeah, use this as a Semi. Since the units, the total number of units of the Tesla Semi is still low and will continue to be a very small percentage even by the end of this year of our total vehicle fleet, it makes sense for us to focus our efforts, our self-driving efforts, on our high volume vehicles, so Model 3 and Y, and solving self-driving and really getting to, you know, the point where it's generalized unsupervised self-driving for those vehicles, and CyberCab. So we expect to get self-driving working on the Tesla Semi probably around the end of this year or early next year. But I just don't want it to be a distraction on the, you know, on the march of nines of self-driving, of safety for self-driving on 3Y and CyberCab. That's so that it's taking a bit of a backseat for the next 6 months or so for autonomous Semi, but it will be, you know, it will definitely be a bit working next year and in time for the scale up to high production of Tesla Semi. For communications, yeah, I think there's an interesting angle there where you could use the Starlink terminals that are in the Tesla cars as like sort of cell towers, I suppose, or connectivity towers, basically for providing relays on the ground to cell phones and to anyone who would like Wi-Fi, basically. But yeah, I mean, it's a different subject, but obviously one could do that with the stationary Starlink terminals too.
All right. Our next question is going to come from Will at Truist. Will, please unmute yourself.
Great. Thanks so much for taking my question. Elon, you teased us a little bit about sort of the supply chain relative to Optimus, highlighting how difficult it's going to be, but we'd be really interested to understand what your propensity is to manufacture semis for this yourself. When we think about microprocessors, microcontrollers, actuators, and other semiconductors that are going to be used, it occurs to me that you have many that are commercially available. You have an option to design some but have them made at third-party fabs. You also have the option potentially to design and make them yourself. What should we think about your propensity to source these components in these different manners?
You're talking about like making like microcontrollers and small, like the various computers that are in the car that operate, you know, like the steering system and the braking system.
No,
that kind.
I'm talking about for Optimus, not for
Yeah.
not for the car.
Yeah. Optimus has a lot of really specialized power electronics and circuit boards. It's all Tesla design stuff, but it is fabricated by suppliers. For Optimus 4, which will be built in Austin, that will be a much more vertically integrated supply system for Optimus 4, and that would, you know, we'd aim to have an order of magnitude more production of Optimus 4 than Optimus 3. So it's sort of aspirationally 10 million units a year versus 1 million units a year of Optimus 3. But you know, with all the caveats there, which is insanely difficult to scale production. And yeah, Optimus 4 will be much more vertically integrated. So probably doing a lot of the sort of PCB work in-house for that.
As a follow-up, well, first, maybe you could talk about the timing as to when Optimus 4 should be, let's say, start production. But the actual follow-up I wanted to ask was the plan to upgrade hardware 3 to hardware 4 in order to be able to process, I suppose it's version 15 of the and future versions of FSD. Is that still the plan to do hardware upgrades on the cars?
I think it's going to make sense to upgrade all cars with that are have less than hardware 4, almost all, any cars that have cameras, basically, because otherwise it would be probably too many modifications. But anything that's got sort of that's set up for cameras, it'll be financially sensible at some point to upgrade them. But I think we'd want to upgrade them to the next generation of you know, like next generation AI board. So it would be either like we have an upgraded AI4 chip that's sort of a medium, sort of a moderate improvement over AI4, probably reaches production around the middle of next year. And then there's also AI5, which hopefully is in volume production around the middle of next year. AI5 will initially go into Optimus. And actually making very good progress. So the Tesla chip team is really doing great work and making incredibly fast progress on AI5. And I'm very excited about the design of the Tesla AI6 chip. I think it's going to be the best edge computing chip in the world. And if somebody's got a better one, I'd like to meet that person and shake their hand, because the AI6 chip is just so good. So I think I think it's going really well on the chip front. Yeah, and again, I'd like to thank TSMC and Samsung and Micron for the support.
Great. We are coming up on the hour, but we're gonna try to squeeze Dan in. So from Barclays, Dan, please unmute yourself.
Great. Thank you. Appreciate it. I'd like to ask about the pace and path of CapEx. Elon, in the past, you've said that you'll spend as much as you can, but really efficiency seems like it's the gating factor. So, to what extent right now in this CapEx cycle is your pace of CapEx effectively capped simply because spending any more would be done in an inefficient manner? And to what extent is the pace of CapEx really the primary determinant right now in unlocking the different supply constraints that you have?
Yeah, it's a good question. I've actually, what I've asked the Tesla team to do is like really we should be spending on CapEx as fast as we can spend, as fast as we can without it being too wasteful. So we're not trying to aim for like some extremely high efficiency capital spend because that would slow things down. So it's a balance between like how much sort of capital efficiency versus time. So if we can be, it's okay to be a little less capital efficient if we get things done sooner, because that's actually going to be the higher NPV outcome for the company. So overall, I'm pretty happy with how things are going. I mean, we're doing an incredible amount of construction and production growth in so many different arenas simultaneously. I don't think there's ever been a company that's done this at the scale, maybe proportionately back when Henry Ford did the Model T or something like that, or World War II when companies were making, it had to sort of scale up weapons production. But I think probably this is the fastest industrial scale up since World War II in America.
Yeah, and I will just add a little bit on that. Basically, if you look at it, all our spend on CapEx is trying to do productive assets, right? We're basically scaling factories, whether it's Optimus, whether it's Cybercab, whether it's LFP factory, which went into operation earlier this year, or the semi factory, or even putting in a semiconductor fab in there, as well as, we are trying to get a lot of solar manufacturing in the US. In fact,
Yeah,
our
very important.
plants-
This is underrated, by the way. Just go ahead.
Yeah, I was going to, basically, the amount of solar manufacturing which happens in the US, we're just going to multiply it with an order of magnitude. And none of these things are easy, right? Because what you have to do is, in order to build a factory, you have to start from ground zero. So just so you know, again, I don't think we have shared this. We end up being the general contractor for almost all our construction facilities because we are doing that much construction. And so going back to what Elon was saying, we're going at a very rapid scale. And yes, this means that we are doing a lot of things all at the same time. And that's why, we just have to go as fast as we can, humanly make things work in the real world.
Yeah, but our CapEx efficiency, I think, is off scale good.
Already. And then Dan, did you have a follow-up that we can wrap up with?
Yeah, maybe just a quick question on energy storage, which I think is a key topic here. Maybe you can just address, to what extent is energy storage going to be supply constrained for the foreseeable future, and then just to what extent are the deployments right now the typical peak shaving that you'd see at utilities versus you've talked about in some of your materials, for battery storage, addressing the quality of power issue for data centers, given the sharp fluctuations in power use, where you have an advantage given software or power electronics. So just what is that demand curve right now between data centers versus just broader peak shaving for utilities?
Well, it's still mostly it's not just peak shaving, but it's also grid balancing. So it's not just like the packs are on briefly, but for balancing power from wind generation and solar generation, batteries are awesome. I mean, the solar battery combination will be how the vast majority of energy in the world is produced in the future. That's already, of course, how all of the Starlink satellites are powered, is with solar panels and batteries. So, and you can just think of Earth like a giant satellite. There's far more power available from the sun than anything else by far. And we think power constraints are going to be there already are a major issue for AI. You know, just turning on the AI computers. The AI compute demand is so high that people are having even the so-called the hyperscalers are having trouble turning on their AI compute and finding the power and then smoothing the power with especially for the training runs where the power cycles dramatically in a very short period of time. You can have during a training run the power consumption can drop by 70% for 100 milliseconds, and you really need fast-acting advanced power electronics to be able to smooth out these massive changes in power, especially during their training runs. So that's why SpaceX has bought so many megapacks for the data centers. It's actually mostly for smoothing out the power for the training runs. But it will also be useful for being able to tap more power from the grid by if you tell utilities that they can that they will not need to supply power during the worst hours or the worst days of the year because the batteries can handle it, then that makes it much easier for them to give you power. In fact, I mean, probably the best way to scale total energy production in the United States is simply using batteries, because there's, I think, around 1.2 or 1.3 terawatts of power production in the US, but the average power usage is only half a terawatt. So you've got 2.5 times as much power generation as the average usage. That means you could potentially double the energy output of the United States just with batteries. So we see demand for Megapack being very, very high in the future.
Alrighty. That is all the time we have for today for Q&A. We appreciate everyone's questions, and we look forward to talking to you next quarter. Thank you very much.
Sure. Thanks, everyone.
Okay. That was Google and Tesla. Q2 2026. I think let's start off with Google, and then we'll get into Tesla. It was a long 2 hours, but we got through the calls. Tanner, start with you. Raw thoughts on Google.
Real quick, from my understanding, Google was a pretty mediocre, well, not mediocre, but the enthusiasm on the call was sort of like a base level. If ServiceNow was a drug, it would be an upper. I mean, everyone said that call was amazing. I wish we listened to it. I'm going to have to listen to it tonight. And Tesla's was a downer, bro. I should have brought out a little blanket here. I should have went to sleep. It's too quiet. I can barely even hear. Like, it's like almost cutting off his mic at certain points.
There's something wrong with his mic. Because his
Yeah.
audio was weird from the other guys.
That said, sorry, going back to Google.
Real quick, before we continue, I also cheated on Google and listened to ServiceNow. I didn't listen to the whole thing, but man, Bill McDermott was on fire. Like, I mean, there are certain moments where he was like emphasizing certain words that made it obvious that he was implying, guys, what are you doing here? Look at our numbers. We're winning. There are some clips we're going to have to play from it yesterday. Like, that was what a winner sounds like. And he had the numbers to back it up. I know the stock's like not doing too much, but that was a good call. That was a good call by Bill McDermott.
I literally walked my dog.
Okay, I didn't leave you guys. All right, I was
No,
here.
I
Tanner
was
left
on
you
the
guys
phone.
walking the dog.
I was on the phone and listening to the call and talking in the chat. But yeah, I've been live since 12. Okay, give me a minute. I needed
right,
to see the
Google.
sun. But that being said, I've been going through a lot of Google's call, and there were some really, really good snippets of what they talked about in the quarter. That part which Jose highlighted whenever the call was paused, we need to talk about more, which was that they talked about Q3, how they're going to ramp up third-party capacity. Now, at first sight, I actually thought that they were talking about the SpaceX deal. But the SpaceX deal is very interestingly signed to go live on September 30th, 2026. So it's actually essentially the beginning of Q4 is when they're going to have to start, getting capacity online from SpaceX. So Q3, it's likely that we're going to actually see a different type of customer, whether that's, Nebius or CoreWeave or whatever. A lot of these stocks are reacting positively, but they are also at capacity as well. So it's going to be still quite a long time before you actually get some capacity online, unless Google does a deal with Meta in which they could get capacity online immediately. If you're holding both those companies, it's a pretty interesting day.
Jose, your thoughts on the Googs?
Yeah, a few things that after I was kind of reading the transcript as Elon was talking. I enjoyed Google's call a lot. They talked that they have a $500+ billion in backlog now, and they mentioned within the next 24 months, half of that is going to be taken as revenue. I think that's pretty insane. That so they expect Google Cloud to do roughly $250 billion in the next 24 months. Which I think is good. I mean, I think right now they just hit a 100 annual revenue run rate if you do it on this quarter. So exciting growth there. The other thing that I found interesting is they mentioned that they don't mind taking these short-term neo cloud deals, which kind of Tanner was talking about, because for them it's like, if I am going to have an AI infrastructure that is going to turn on in 7 months or 8 months, even if I have to pay a little higher margins on NeoCloud player for an 8-month contract, it's still extremely beneficial for me to do that because these long-term agreements tend to do really well on the margin side. So I think it's pretty good, because I think for like the NeoCloud players, 8-month contract is going to be something like what we see in SpaceX, where the margins are extremely high, and it's going to help reduce a lot of the money that they need to kind of stand up some of that AI infrastructure. So those were the two main things that really grabbed my attention. If there was one more thing, is Sundar really acknowledged that Gemini was lacking in two main places: agentic solutions and coding solutions. And he says just keep a closer eye on for Gemini 4. It's a much larger model, and I think we're going to continue to see that AI race move forward, and you're going to see the competition between Gemini, Grok, which is now also doing really good. Meta has reawakened, OpenAI. So it's gone from a battle of just, I would say like 3 months ago, many people thought it was just back to OpenAI and Anthropic. And I think in the past week or so, it's shown that Grok isn't behind, or it's not game over for Grok. It's not game over for Meta, and it's not game over for Gemini. The thing that I saw on X for ServiceNow, I actually want to listen to ServiceNow call later. The CEO mentions that cybersecurity was going to be the biggest portion of the overall business. And that's something that, again, I think we kind of started this call or the stream talking a little bit about how Pandora's box.
That might be enough of a reason to take a gamble on ServiceNow, because you're getting the legacy business, which is growing 24%, stocks down 50% from the highs. And what are the stocks and SaaS that have done well this year? Cybersecurity names. ServiceNow is the 8th largest cybersecurity company now with the acquisition. I mean, that makes it very compelling to think of a more deeper approach to ServiceNow.
Yeah, so I want to listen back to the call just to hear that cybersecurity commentary. I think even Sundar mentioned it in this call where cybersecurity is becoming very, very important in the AI growth phase.
Yeah. Dude, you highlighted a really big point about Gemini 4 that I think is super important, which goes against the recent consensus about how these Chinese models can end up lowering training costs and, lower the cost that it takes to get to Frontier. What they said is, no, actually, to get to Frontier, we're going to have to spend way more than we ever have. We need bigger bases on these models. We're going to need more training for these models. They actually said exactly what NVIDIA wants them to say. If you want to get to Frontier, you're going to have to spend more than ever. And so for the AI infrastructure plays, if you want to believe that there's money in enterprises that they are going to spend for these types of models, and that can be through ServiceNow or something like this. It still means that Anthropic or OpenAI still get their nut, But if what?
Nothing.
Like a squirrel, bro. Why are you laughing?
No, nothing. I just, nothing.
Okay. Well,
it's good analysis.
Thank you. And
Okay, so hold on. I'm going to ask Tanner a question. After he answers that question, I have a question for everybody else. Put your comment in the chat. Bill McDermott's on CNBC right now. Do we listen to him on CNBC after I ask Tanner this question, or do we talk about Tesla? Put in the chat. Let me know what people are thinking. Okay, Tanner, the question to you is, does Google deserve to be down based on increasing CapEx?
That's a hard question. I think that investors should be hesitant about any industry that's willing to spend without measure. This is unprecedented times for Google. For the last decade, we've gone from decreasing shares to now increasing shares, and free cash flow went negative. That is a different situation. But I mean, there is no better business to see a forecast into their future revenue than Google.
Yeah.
They understand the advertising. They understand why they're spending this much. They understand that the cloud revenue and the reason why they don't want to spend and pay SpaceX and Nebius potentially or any other one of these companies is because they want to capture the market share. They want their nut. And so if you're going to do that, then you have to be willing as an investor to say, hey, we have to be comfortable with the spend. They know what they're doing better than us. Google is a better capital allocator than me. I think that's a fair statement. That's one that I'm willing to bet on.
And there's the ROI right there on the screen. It's working.
Dude,
it's not
they
only
grew like 2.5 times faster with almost a 50% increase, if not a little bit more, on margin. Like, that's crazy. Like,
it's working. The ROI is there.
It's not just a 15% increase in operating margin. You went from 2.8 to 8.8 billion. Focus on the actual number.
I agree.
Tanner saying nut on repeat just sounds wrong. Chad, I'd love to have you on my channel one day and talk about Palantir.
Yeah, Chad, you might have to go on Tanner's channel soon because he's getting pilly-pilled, baby. It took 5 years, but he's getting pilly-pilled. Chad would be a great person to talk to, actually.
Just while I got your attention, I'm corporate safe. Don't worry.
There you go. Deal. All right.
Yeah, there you go.
Mr. Chad. Yeah, I agree. Jose, I think you would agree as well, right? Like the ROI is there, the increase of revenue is there, but the stock going down, kind of inevitable, right? If they're going to be spending on CapEx.
Yeah, exactly what Tanner said. Minus the nut.
You
There you
never
go.
minus the nut.
There you go. All right. Here's Bill McDermott on ServiceNow.
R2, sir.
I am, Jim. Great to be back on your show.
Okay, so Bill, revenue growth, some serious acceleration. People were concerned maybe the last couple of quarters they didn't have the growth that they wanted. This seemed to be the quarter where you definitely have pretty strong bookings. Looks good.
It's been great, Jim. You know, we're the fastest growing major enterprise software company and now cybersecurity company, and we're operating at the rule of 56. So the company's firing on all cylinders. This AI control tower for business reinvention, really driving AI, but keeping these companies secure with all the agents, all the critical infrastructure, networks, and devices. We're in the cyber business, Jim.
Yes, look, the ServiceNow's blueprint for agentic business. After what happened today with OpenAI and Hugging Face, I thought that this was a brilliant document. And I did not know that you do this, for a huge percentage of the Fortune 500, you're involved in this.
Absolutely. In fact, right now, the AI control tower is really taking the Fortune 500 from AI chaos to AI discipline. For example, this token consumption has become a big issue, as you know. We manage that, enforce those policies, and the kinds of things that are happening in the media today around AI. We have a kill switch that stops AI agents that go rogue. So those things don't need to happen, and they wouldn't happen when companies run ServiceNow.
Okay.
All right. So that's kind of the extent of what we got from Bill McDermott. Again, obviously on the earnings call, he was a bit more hype as he was speaking directly to his investors on the call. But at its core, I think the cybersecurity angle is going to be what he goes for. But notice what he said right there. Two things. First of all, he said we're the fastest growing enterprise company. That's not exactly true because Palantir is growing at 85%. And then number two, he said we have a rule of 56. Palantir's at a rule of 140. So, think about the market's reaction to ServiceNow up 5% after hours on relatively good results, 24% year-over-year growth, rule of 56. And then think about what some of the other software companies are doing that is obviously at a level that is, ServiceNow did about 3.9 billion in revenue. Palantir is going to do around 1.8 billion. Not that far away. Palantir, if it grows at this same level next year, is going to catch up to it. So the point is, software is not dead. ServiceNow is not dead. Palantir is definitely not dead. But if the market actually takes down ServiceNow tomorrow on these good earnings, and then as a proxy takes down Palantir on these good earnings, it just means that this narrative of Google spending on CapEx, which means the money goes to Micron, Nebius, CoreWeave, et cetera, drains the liquidity out of many of these software companies, including ServiceNow, Palantir, et cetera. Now, some of the software companies are not growing that much, and they probably don't have something to be excited about. But the ones that are growing and that are still getting thrown out with the rest of them, I think that's where the opportunity is. I think that's why Tanner's been getting really excited about Palantir. That's why a lot of people are excited about Microsoft right now. And it feels like if the market's going to give us another opportunity to get these software names, the highest quality ones, then that could be something we take advantage of.
You know why I'm excited about Palantir? Is because if Palantir had 0% revenue growth, they'd have a higher rule of 40 than ServiceNow.
Which is insane.
It's insane. You could put either one of their arms behind their back and they'd still punch harder.
Yeah, I mean, by next year, if they keep up even half of this revenue growth, they're going to be catching ServiceNow in terms of revenue, which once again, it's one of those things where if you look out a year or two into the future and you look at the earnings multiples and believe that they're going to execute on the growth that they're executing on, and they're not going to be commoditized by, that's the biggest thing. Dude, Anthropic and OpenAI building these like AI forward deployed engineering codes that are going to take out all these enterprise software companies. I'm starting to think it's absolutely bullshit. It will work for like the Paths of the world, but for complex software systems like a Palantir Ontology that is integrated into an ecosystem, as Karp said, you're not trusting Anthropic and OpenAI. I think the market has started to recognize that. But when Google says we're going to spend another $30 billion on CapEx, the market says, well, we don't care about software because Nebius is going to benefit from it more immediately. And I think that gyration of capital, which is not always going to be the case because one day Google will stop spending, but if that's not going to happen tomorrow and foreseeably for the next few years, based on what Google said on this call, the semi names continue to catch the bid. Jose, Tesla, we'll start with you. Any excitement from that call?
Well, I don't think so. I mean, I personally didn't think I got anything.
Bro, we're all cooked. Let's go.
I don't
honestly. You guys are. I obviously took a phone call during the Tesla call because I had to talk to somebody.
To Tom.
Yeah, to Tom. Shout out to Tom. Missed his question, dude. It was just a bad call. It wasn't exciting. I talked about this yesterday on the close. Like, what has happened this year that is actually exciting for Tesla?
Yeah,
not much, right? And that's the issue. And that's why the call, they had nothing to really get excited about.
Yeah, and the main reason is I was definitely wanting to hear more about the Terafab, and he was like, "Hey, the Terafab is too big, so we'll probably save it for another day." Right. So after that, I kind of was like zoned off. But
Bro,
they're
they also didn't even answer retail questions. They like summarized the questions on Say Technologies that retail submitted, and they grouped them together. They didn't actually read out the questions. So I think they were also just like tired of dealing with some of the same questions because they don't have new answers because nothing in the business has fundamentally changed. Then they kind of just streamline through it, right?
Yeah.
Yeah.
Elon at the beginning said that the Optimus ramp is going to take way longer because every single new part, like there's no one to look to even know how to do this job. And I think that's a fair statement. But I think the biggest criticism to Tesla is they always push off the timeline of whenever things are going to really ramp. The profits are coming later. They're always coming later. And essentially what Elon came out and prefaced was that Optimus is going to take a really long time to really start ramping production.
Can we actually focus, because people are buying humanoid robotic SPACs, and the biggest humanoid robotic company in the world CEO just told you this shit's not happening tomorrow.
Yeah. He said it's going to take way longer than people are giving it credit for, and I think it just pushed the goalpost even further. And
I mean, how do you even buy the supply chain of the humanoid robotics companies if the humanoid robots, like the reason the supply chain on the GPUs makes sense is because NVIDIA is selling a shit ton of GPUs. If Tesla or Figure or Apptronik aren't selling the robots yet because they're not good enough from an AI perspective and from a manufacturer, Elon spent a good amount of time, to your point, Tanner, explaining how hard it is. I mean, he said it's the toughest problem to solve from a manufacturing perspective in history. So why do we think robots are coming anytime soon in any meaningful way?
Yeah, exactly. He's saying this is super hard, not this is super easy. It's like, it could potentially lead to a moat, but it also means that the problem might not be solved very quickly.
There was some bullish stuff on the card side, on the automotive side. They do mention that now people are kind of buying Tesla for the FSD opposed to the actual vehicle. And I mean, just on a personal note, I feel like I've talked to my wife, and if we get rid of our Tesla, the only other vehicle we would have to buy, or if we have one, we have to get one more. It has to have FSD, right? FSD has completely changed. So the driving for us. So it's cool to see that. And they mentioned, I think 55% of vehicles that are now sold are sold with FSD. But that's no longer why people invest in Tesla, right? I think that's old news, but it's still, I guess, good for their main business just now.
Yeah, I mean, the worst part about the Tesla numbers is almost 70% of their EPS was because of SpaceX, the $1 billion stake they have on SpaceX.
Yeah, which
Google,
was not included in the estimate.
Which was not included in the estimate. Same thing for Google. Google made $99 billion off SpaceX and Anthropic, and I think a couple other private investments. So that's why the EPS beat didn't look that impressive. Google actually missed EPS without their. It was 285 versus 290 expected. They came in at 911 versus 290 because of the unrealized gains. But Tesla barely had any profit, like literally like a couple, 10 cents of profit without that SpaceX gain. So I think that's why the stock is actually getting hit. But Tesla's been pretty resilient, not losing 300 this year. So I wonder if it will. Elon also did say, we're spending CapEx aggressively over the next 2 to 3 years. So Elon will join the race of spending CapEx, maybe not hundreds of billions like Google and Microsoft, but still a good chunk, which means I think the biggest winner today is the semis. Like they got everything they wanted to hear in terms of more money in this ecosystem being spent, the trajectory of the rate of growth of that money continuing, and then these RPO rates and revenue rates on cloud for Google, they're going to have to be the same for Microsoft and Amazon, and not literally 80%, but they're going to be more than what they were last year, which means all those guys are going to spend as well. And then if Meta says, hey, we think there's a really big opportunity to service AI compute, like I don't see how the semis aren't the biggest winner today. Given the earnings call that we got.
Yep. NVIDIA back to 190. just because I hold it.
Now again, the semis have been in a downturn because of the high beta momentum drawdown, but part of that drawdown has been because of fears around CapEx. So you may still think the semis, the risk reward might not be amazing, which is, that's a fair point. But the fear of CapEx, I think this Google and Tesla call kind of resolved that because Meta, Microsoft, and Amazon are going to say the same thing. And so then the question is the risk reward good enough?
Yeah, I think the market is always going to be scared about this because now with companies going like Google going free cash flow negative, the new bearish thesis is they can't go free cash flow negative for a very long time. So this means that the AI CapEx story is ending. So it's like, it gets tiring trying to be an AI bull, but we
No, but it's a good point. Jose is basically saying this is the first quarter Google went free cash flow negative in what, like, I don't know, 8 years, 9 years. So how long will they keep up free cash flow negative? Now, they said on the call that they're going to I forgot the wording, but they were like, this will apply pressure on our free cash flow. That basically they're implying, yeah, don't expect any free cash flow next year. But are we going to go 2-3 years with no free cash flow? NVIDIA's going to get all of it. Micron's going to get all of it, because I don't know, right? It's hard to be able to be like, yeah, that makes sense. But it also is like, yeah, that makes sense because they have to spend the CapEx. So it is a bit confusing to kind of dissect how this will play out.
All right. We wrapping there?
Yes, we are wrapping there. That is pretty much it for us. Thank you all for joining and for being here.
Thank you, chat, for all the jokes. I appreciate it.
Yeah, we needed the jokes to get through these calls today. We absolutely needed the jokes.
Thanks, guys.
Yeah, Tesla down a bit after hours along with Google. We will cover more of this stuff tomorrow. IBM ServiceNow up a little bit. And tomorrow we got Intel. I think we'll all three be here for Intel. And then we'll be able to cover those earnings as well. All right. Thank you, everybody. We'll see you guys tomorrow.
Bye, everyone.
Bye, everyone.